If we get everybody in the room, we'll start in a minute. Good morning. I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy at Brookings. I want to welcome you on behalf of the LBJ School at the University of Texas at Austin, the Rosenberg International Business School at Brandeis, the Mitch School of Business at Purdue, and the Harris School of Public Policy at the University of Chicago to the second day of our Municipal Finance Conference, which I am certain will be as interesting as yesterday was. As you know, this is being live streamed, so be careful what you say. I want to, before we start, just call out a couple of my colleagues at Brookings who have been really instrumental in making this work, especially since we had to move to a different auditorium, particularly Hao-En Chen, who's the maitre d' of the whole operation, but also my colleagues Stephanie Sula, Meg Waring, Andrea Napita, and Ben Wink, who have been helping out today. So the plan today is we have two paper sessions. Dan Bergstresch is going to do the first, which is very focused on the muni bond market, and then Christine Cooney from NYU is going to moderate the second. We'll have a break in between on immigration and labor mobility, and then at the just before the end, my colleague Louise Shaner is going to moderate a panel, which I'm sure will be interesting, on the impact of the Trump presidency on state and local governments and higher ed. For people who are on the MFC Advisory Committee, we'll be meeting in a room off in the corner there immediately at the end of the conference. So unless anybody has any questions, Dan, the floor is yours.
Okay, can you all hear me okay in the back? Okay, we have a great panel this morning. I want to use the 1 minute that I have as the moderator here just to quickly say something that I'm very, very serious about. These steps are uneven. As you come up the steps, the last step is higher, and if you're not careful, you will trip over it. Got it? Okay, with that out of the way, we got Casey Dougal. Take it away. Oh, you did two at a time.
Yeah. All right, good morning, everyone. Thank you so much for being here, and thank you so much to Brookings for hosting the conference and inviting our paper to be presented. So my name's Casey Dougal. I'm from Florida State University. And today I'm going to be presenting my paper, Dealer Quid Pro Quo in the Municipal Bond Market. So this is joint work with Daniel Redl and Vasily Yakimenko at the University of Georgia. Vas is here today. He's right there. He's a PhD student right now. He's not on the job market this year, but next year. But he's a fantastic co-author, and I invite everybody to kind of keep him on your radar. I froze. I get my time back, right?
Things working.
My apologies. All right. Fantastic. So the setting for our paper is the municipal bond secondary market. Now, muni bonds, they trade over the counter. So unlike, say, stocks that trade on a centralized exchange, trades between muni bonds are intermediated by broker-dealers. So for example, if I have a bond and I want to sell it, I'll go to my dealer and he'll buy it from me, and then he can turn around and sell it to another customer. Now, if he doesn't have a customer immediately, what the dealer might do is he might turn and sell it to another dealer, who could sell it then to another dealer, and so on until an ultimate buyer is found. This is known as a transaction chain or an intermediation chain. Now, each time the bond is sold, a small markup is charged. Now, individually, these markups are not that big, but collectively, especially when the transaction chains are large, the overall markup to the chain might be large, and the cost borne by the customers might be big. And so we're interested in understanding how dealer characteristics influence these transaction costs. Now, prior research has found that the dealers are set up in basically a hub and spoke network. So in the center of the network, you have about 30 core dealers intermediating most of the trade, and on the periphery, about 1,000 smaller dealers intermediating just a little bit of trade. These core dealers, they found, charge about double what the peripheral dealers charge. And effectively, what they're charging this for is either extracting rents or because they're more efficient at finding buyers. They can execute faster. And so what we're interested in studying is another dimension of the dealer network, specifically the reciprocity of dealers, or how mutual their relationships are. And by that, I mean we're measuring the reciprocity of dealers by their node reciprocity, which is a network-based measure. That is essentially the number of bidirectional connections that a dealer will have divided by their total connections with other dealers. And so we hypothesize that dealer reciprocity will lead to both positive and negative outcomes. So on the positive side, we think that dealers will trade lower markups today for future liquidity and lower markups tomorrow. And on the negative side, we think it's possible that dealers might use their networks to facilitate collusion, a kind of quid pro quo arrangement where they increase markups that the ultimate customer is charged. Now, which result obtains, we think, is going to be a function of dealers' network sizes. For large networks, competitive networks, we think that reciprocity is going to manifest itself by lowering cost. In smaller networks which facilitate collusion, we think markups are going to be higher. All right, so to kind of help your intuition, a small example. So suppose that bonds are trading at $100 and markups are about 1% of the face value of the bonds. And let's imagine we have a trade. It's just a simple trade. There's no interdealer trade. Dealer A buys a bond for 100, resells it for 101. The buyer pays a markup of $1. Dealer A makes a profit of $1. All right, so that's kind of the base case. Now let's add an interdealer trade. So now we have dealer B. So same thing. The first leg of the trade is the same. Dealer A buys the bond for 100. Now they resell it to dealer A or dealer B with a 1% markup, who then sells it to the final customer with another 1% markup. Now, the buyer here is worse off. They're paying $2.10 instead of $1, but dealer B is better off. They're part of the deal now. They're making money. Dealer A looks like they're about the same off. They're still making $1, but here's a catch. Dealer A is better off because dealer B now owes them a favor, effectively, right? Dealer A brought dealer B into the deal, and so now dealer B might give them preferential treatment on another deal. So for example, they might provide dealer A liquidity when they need it, or we think kind of the simplest way of repaying the favor is the next time that dealer B has a bond, they might just reverse the trade. So trade one is dealer A trades to dealer B. Trade two is when dealer B gets a bond, they then trade to dealer A. And so across both deals, everybody, both the dealers are much better off. Instead of making $1, they're making $2.10. And the buyers are worse off. And this, we think, is kind of an example of the collusive outcome. Now, this doesn't have to be the case. Dealer A might recognize that, look, in this example, we get more volume, and so I can actually spread my cost across the deals. So I might be willing to lower the markup that I'm charging on each trade. So instead of $1 or 1%, maybe I charge 50 basis points. So across both trades now, dealer A still makes $1, dealer B makes $1. Buyers are no worse off than when there's no interdealer trade, and we think this is kind of the cooperative outcome. And even though dealer A is still only making $1, they're still better off because, well, they have this relationship now. The market has better liquidity. In times of distress, this relationship is probably going to help them. So they might even be willing to lower the markup to, say, 40 basis points, and the buyer could be better off. All right, so that's broadly kind of our intuition. Once again, our hypotheses, we think that dealer reciprocity is going to manifest itself in one of two ways. It's going to either lower transaction chain markups, or it's going to increase it from dealer quid pro quo, and we think which outcome obtains is going to be a function of network size. The negative outcome is going to happen only in small networks. So to look at this empirically, we use the MSRB academic data set with anonymized dealer IDs. We have 5 years of data from 2014 to 2018, which consists of about 1.5 million round-trip transaction chains. We measured dealer characteristics using 30-day rolling averages, similar to other papers in the literature. So we measured dealer centrality, their reciprocity, their network size, which is their number of unique counterparties, their inventory, their market share. And then the outcome we're interested in is the total markup on the chain. Some sample statistics. So our data matches other studies. Average markups are about 1%, standard deviation of 2%. Average trade size is about 70,000 with a median of about 25,000. Now, to kind of show our results, I'm just going to focus on some simple averages. The first thing we'll look at is basically these chains sorted by the reciprocity and centrality of the first dealer in the chain. Okay, so we just sort dealers into terciles based upon their centrality and reciprocity. So this first panel, we have the low centrality, medium centrality, high centrality. So it's the peripheral dealers that have the lowest centrality, the core dealers that have the highest centrality. Core dealers, of course, have the biggest networks. And then low reciprocity and high reciprocity. Similar to other research, our data set has about, if you look at that bottom row, about 25 core dealers, where most of our dealers are on the periphery. And I've highlighted in red the peripheral low centrality, high reciprocity group. So we think that is where it's most likely that collusive outcome will obtain. Now, if you look at the next panel, panel B, that's not a lot of trades. That's like 2% of all these transaction trades, but as we'll show, they're kind of anomalous. All right, and here I'm going to just show averages by these sorts. So the first thing we're going to show is the average transaction chain markup. And if you look at the medium centrality, high centrality dealers, that's the main result of the paper. Basically, so for example, take that bottom row, the low centrality or high centrality, low reciprocity dealers charge about 2% markup on the total chain, whereas the high reciprocity, high centrality dealers charge about 1.2%. So a difference of about 80 basis points on the chain. So a fairly substantial difference. Same with the median centrality dealers. What we find, though, when you look at the peripheral dealers, the pattern kind of flips. And what we see is that high reciprocity, peripheral, low centrality dealers actually charge really high markups of about 1.5%, or about 70 basis points higher than their low centrality, low reciprocity peers. Going along with this story, if you look at the average chain length in that next sort, we see that low centrality, high reciprocity dealers have chain lengths of about 4 interdealer trades. This is much bigger than any other bucket. Typically, the chain length gets a little bit bigger, but not that much bigger as that one group, as reciprocity increases. And then finally, if you look at the average network size, this is where the puzzle kind of deepens. Usually, the network size increases with reciprocity, right? The more people you trade with, the bigger your network gets, except in that one outlier group, where their network size is about 1.3. So what does it look like? You have this group that are charging really large markups. They're trading back and forth. The networks are quite small. But otherwise, reciprocity tends to be good. It makes networks bigger. Now, this might be a function of, say, bond characteristics. So what we do is we look at abnormal transaction markups. We get the same patterns. We think that it might be the case that these dealers are using the bond characteristics to maybe bamboozle retail investors. So for example, maybe they're using complex bonds where they can hide their pricing shenanigans a little bit easier. It seems to be the case. We find evidence that they use coarse prices more than fine prices, so prices that are at quarters or odd eighths, suggesting that they have more discretion in setting prices than other dealers. The next thing we look at is to see whether or not past reciprocity predicts future reciprocity. And so what we look at is if dealer A trades with dealer B, what's the probability that next day dealer B trades with dealer A? And we find that a 1 standard deviation increase in dealer reciprocity leads to a 7% increase in the probability that that reverse trade is accomplished the next day, or relative to the baseline, that's about a 30% increase. For that high reciprocity, low centrality peripheral group, the probability of reverse trade is even larger. Next, what we do is we sort our results by network size, and we find that only in the smallest quintile of network size does dealer reciprocity lead to higher markups. Otherwise, reciprocity generally leads to lower markups. consistent with kind of positive effects of reciprocity. And then finally, what we do is we try to use an unsupervised learning algorithm to identify trading communities within the dealer network. And so we use this Louvain algorithm, and it's kind of a black box where we kind of group dealers into communities. And what we find is that when dealers trade within their same community, markups are about 50 basis points larger, but that this decreases with the community size. Now, the average size of these communities is about 3.5 dealers, so on average, reciprocity trading within the community is a good thing. It's only when the community is really small and it appears that they're just trading back and forth that they're really marking up these deals. Now, this is a bit of a black box, so what we do is we try to use feature analysis to figure out, out of maybe 100 or so different features, what is most salient to this community construction. And what we find is, lo and behold, I think in the top 5 is dealer reciprocity. And so reciprocity is fairly important for forming these local trading networks. All right, so I'll conclude. We think that the effect of dealer reciprocity on price discovery and efficiency is really two-sided. So most of the time, dealer cooperation grounded in a system of favors reduces markups and passes on the savings to customers. So I focused a lot on that kind of outlier group, but really the main thing that we find is that for the most part, 98% of the time, these relationships are really beneficial to people, are really beneficial to customers. Some of the time, though, it looks like there's some collusion going on. Now, that's kind of a strong word. Obviously, it could be something else. One of the shortcomings of our study is that we don't observe the dealer identities. Everything's anonymized. And so if we could know more about that, we might be able to say more things. But we think that probably some more investigation into those group of traders might be warranted. All right. But that's it. Thank you so much.
Thank you very much. Okay. Everybody can hear me, right? Okay, so I'm not going to spend too much time on this, but this is a great paper on this slide. So this is a great paper. This paper identifies, as the author says, a new force that is quite strong in dealer networks. And I think what the author finds is that it does play a role both at the core. Reciprocity does play a role both at the core of the dealer network and also on the outside, right? So this is very key because his results are going to vary whether he looks at the core or whether he looks at the periphery. Okay, so let me just go straight into it and talk a little bit about the contribution of the paper. So I think this result is actually more broad than just applying to the bond market. I've seen this type of actions occurring in the loan market as well. You see banks that are on the same deal over and over again. And I think the authors maybe can play up things a little bit, right? Because this is just a very broad trends that I've seen in financial markets. Now, when it comes to my points, I think they're going to be, for most part, on some of the measurement, and I think this is something they can fix. And then second, I know I might be asking too much, but the sample is fairly short. I think it would be nice to extend the sample a little bit because the muni market has changed a lot since 18. Okay, so I have two major comments, actually really one comment. The second comment is a little bit shorter. But okay, so my first major comment here. So the electronic trading has increased a ton even during the sample of the study. So just to give you a sense, so there's a number of studies from MSRB that were done on this, and I took the very last one but I think you can go over time and you can take even the ones from 16. I think they would show you that about 50 to 60% of all dealer trades were done via an ATS, right? And so now, why is this an issue? Well, so I don't think it is an issue, but I think it could be an issue. So I think what we need to learn more from the paper is how basically these ATS trades like factor into the intermediation chains. So what we don't know is whether part of these chains, like whether one piece or more than one piece of these chains is traded over an ATS. I think this could be an issue because I think the ATS, if say I'm a large dealer and go to the ATS to like buy or sell bonds over and over again, it could be the case that in these data of the authors, I like appear as if I have very high reciprocity, but in fact I'm just going to like to an ATS. I'm not like working with another market maker. I don't have a strong relationship with them. I just go to an ATS, I buy and sell bonds all the time, and so that's why I look like I'm actually very reciprocal. Okay, so this could affect both like the like market makers at the core and also at the periphery. Now, I think what could be an issue here is that, so I made this chart here since 03. You see the Lee and Shurhoff markups over time, right, since the start of the MSRB data. I've split these trades into large, mid-sized, and small. And what you can see here is that all of these markups for all trade types have fallen a ton over time, right? I think it's less costly to trade nowadays, and I think the looming elephant in the room is that this is basically to some degree due to these ATSs who have come into the market and who offer like a lower cost execution. What I can infer from the bond buyer, so now just to be fair, you cannot get data. It's very hard to get data on when they first entered the space and stuff like this. What you can see though is that, and what you can infer from the bond buyer reading these articles back in time, is that they entered around 2010, 11 for the first time, and then they have grown quite a bit. And at the same time, you see these transactions costs fall a ton, right? And so, okay, so I think what could be an issue here is that if I'm a market maker and go to an ATS to get a lower cost, so it could seem in the tests that these lower costs are coming from reciprocity, but in fact, this is due to the market maker going to like an ATS. Okay, so this could like reverse though. If you have a small ATS or like an ATS that's specialized and hard to trade bonds, you may see the like opposite, right? So I think it's important to do like a number of things here. First of all, I think the authors can tell whether a certain trade occurred on an ATS. There's flags, MSRB flags. I think they start in 16, so it's not ideal, but you can still use them for a big chunk of their sample. I think you can compute reciprocity outside of these type of trades and see what you find. I mean, that's not ideal, of course, so you need to, like, in some way, model why I choose to go to like an ATS and why I don't. I think that shouldn't be that bad. I think you can do like something very simple at first, a Heckman model, and then I think you can go from there based on what you find. Okay, so my second point here is basically linked to the second claim in the paper about strategic trading. I think this is a strong claim. And I'm not saying this is false. I'm just saying I think it's a very strong claim, so I think it's a very high a very high burden of proof here. So I know the authors do a ton to alleviate some concerns that this is due to the fact that we're picking up hard to trade bonds. But I think what I would like to see here is something that would pick up a liquidity that changes over time, right? Because I know you include bond fixed effects, but I don't think that's going to fully do it, right? Because things change over time for the same bond, within the same bond, right? So this is something maybe you can think about. You can maybe do more of a hands-on exercise, just a small case study where you look at the same bond and the same bond being traded by a small market maker and a large market maker in the same week or the same day and so on. I know it's hard to find, right? Because if you can't find, it's not very easy to find a bond that would trade on the same day with large and small market makers, but maybe if you look at the same week or the same month, I think that could be helpful. So during your sample period, MSRB put in place this best execution rule. So I think this should be important for you. I think the first version of the rule was released in 2012. I think the rule was finally adopted in 2016. So this was the first step to basically making market makers do something about fair execution. So I think this is something you should look at as the rule goes through the process. So it took a long time for the rule to become a law in the space. So I think you should look at the likelihood it passed and how it was amended over time. I think that could be helpful for you, and whether this the second set of results still hold after the rule was adopted. So that's all I have. This is a really great paper. I think these wrinkles may sound large, but I don't think they are. I think this is something you can address with the data. It's not hard to deal with. My first comment. The second comment may be harder to deal with simply because it's very hard to prove this intent that you're talking about, that they trade with the idea they're offering customers lower, higher costs. Yeah. All right. So that's what I have here. Thank you very much.
Okay, before I open it up to the audience, Casey, I want to give you a chance. Do you have any responses that you want to offer to Yvonne's comments?
Oh yeah, these are fantastic comments. I really appreciate them. I think we definitely need to extend the sample. And what I like is, if we find a null result when we do that, it just means things got better. And so it's the greatest comment ever. I'm the master of null results. I also think looking at post-2016 would be really interesting. I know 2018 too, I think they came out with another rule that said they had to disclose markups on principal trade, so that might be another thing to look at. Relative to the ATS, so Yvonne told us kind of this comment yesterday, so I told Voss about it, and he went back and we have some preliminary results relative to that are kind of interesting. One, that kind of outlier group, we find that they use ATS less than other groups. So they use ATS about 20% of the time. Other groups are using it about, at least in our sample period, 30 to 40% of the time. So that's kind of interesting. And then we split those averages up by trades that were done on ATS and those that weren't. The markups on ATS are much lower than the ATS ones, but the patterns are substantially there in both samples, which is kind of weird. One thing I was wondering is it's unclear to me if just because something's done on ATS, if these relationships couldn't still be facilitated, in the sense that if I, say, submit a request for quote and I do it on an ATS platform, but I only send that request to, say, one or two of my buddies, it's almost the same thing as just calling them up on the phone, but that would still be recorded as an ATS trade. So if anybody understands that more, I'd be interested in talking more about that. This is still something I think I need to investigate more myself, but overall I think fantastic comments. Really appreciate it.
And I have just a clarification question about your work. These low centrality, high reciprocity dealers. So these are the folks that are not the central dealers in the network. One model of the world is, I'm Bank of Dan, I'm low centrality, but all of my trades are with JP Morgan. And so I have all of my trades going on with a high centrality dealer. Would it be possible for me to be, that kind of low centrality trading with, all of my trades being reciprocal with a highly central dealer? Or are those dealers by definition low centrality trading with other low centrality dealers?
I mean, I think usually in that instance what you see is it's a one-way relationship, right? You're selling bonds to JP Morgan, but they're not necessarily buying from you that often. But it's something, worth looking into more.
I see.
Yeah.
I want to open it up to the audience. Jess? Before you ask your question, Jess, we all know who you are, but identify yourself.
Yeah, Jess Carnegie, Penn State. I'm wondering if you can do anything kind of forensically to describe more about who these guys are. Like, as we know, there's a lot of geographic focus in the trading of bonds. So, which bonds are they trading? That would probably tell you something about the geographic location of the dealers. You could see about how big they are by how big they trade or how big their trades are and so forth. I don't know. I mean, I guess what I'm getting at is we'd like to know the names of these guys so that retail investors can avoid them. And I think you could get close with the data you could see descriptively, I think.
Yeah, absolutely. I think that's a great idea, better characterizing them. We do control for a lot of these things in the regressions, so their inventories, their, I guess, market share, the market and bonds and things. But I think, kind of reporting that would be really smart. Yeah, it's a great comment.
Okay, I see Christos and then Tim.
Hey, Christos from Arizona State. Really love the paper as well. And on Ivan's second comment, one thing that you could maybe think about doing is so you probably thought about like a Bartik instrument where you're exploiting the exposure to certain network structures and then using like a crisis maybe. So the GFC as a shock to that network, and that might be something worth exploring. But even if that didn't work out or was hard to implement, you could still probably use some time series variation by just looking at if there's a trade on on days that are like really high uncertainty as per the VIX. So that could be one way forward. The clarification that I had was around the definition of the markup, and I know this came up with our other work with John and Jang and et cetera, was when you compute it, so you're looking at secondary trades. What's the base? So it's like the markup is relative to after, like the first issuance that it enters into the when it enters into the secondary market. So it's after primary. What's the base?
Voss, correct me if I'm wrong, but the markup's relative to the first trade in the chain.
Makes sense.
Yeah.
Perfect. Thanks.
I see Tim and then Brad in the back.
Thanks. So Casey and I actually talked about this a little bit yesterday, but just from as a practitioner standpoint, I mean, at a high level, this generally just doesn't happen in the market. And you have to kind of take into perspective the eat or be eaten mentality of broker dealers. And that is that Goldman Sachs has, whoever the dealer is, their highest priority, the highest priority order is to put bonds away. And by away, I mean to put them with customers. And if Goldman Sachs sells bonds to JP Morgan and JP Morgan then sells the bonds to State Farm, Goldman Sachs has actually lost a relationship opportunity with State Farm. And they definitely don't want to give that to JP Morgan, right? So going away business is the highest priority on the street. I do agree with Ivan's explanation that perhaps the money center dealers are more or less apt to work with ATS. And I think the other consideration is that ATS has blurred the lines between brokers, and broker-dealers. And that is that brokers are actually kind of are almost going directly to investors now because end users can use those ATS and kind of, in a way, go around dealer relationships. And then in terms of regional dealers and what we call it, like maybe not the money center dealers, I think the bigger issue is capital, right? And so maybe there is such a thing as a dealer salesperson on every trading desk, where they actually do have a salesperson who will try to sell bonds to the street as customers. But that business historically has always been secondary to, like, if you have a going away order and a street order, the going away order is going to get filled first. That's what investors want, or excuse me, that's what dealers want. They want to build those relationships. And in fact, the end user, using State Farm as an example, if they saw that Goldman Sachs sold bonds to JP Morgan instead of a going away order, that would actually hurt their relationship with that institutional investor. They don't want that business. So I think that, just generally speaking, there's no feeling of reciprocity among those dealers. They really don't like each other. They work together in syndicates, and there are situations where smaller dealers may go joint on secondary positions to share the risk. But that, again, comes down to capital. So I think, generally speaking, this is more probably what Ivan's picking up on. It's that it might be that some dealers are more inclined to UTS. So that's just some perspective from the kind of the on-the-ground practical.
So I do wonder, I know they don't like each other, but maybe in a distress period, maybe they'd like to be friends. I mean, how much are these relationships worth?
Well, imagine you're the trader. I don't mean to keep picking on JP Morgan.
No
all right,
worries.
but there you have two. Like, let's say the market's tanking, there's no liquidity, and the Goldman trader calls the JP Morgan trader. Let's say they both trade water bonds or long-term bonds or something like that. The JP Morgan guy's not going to fall on his sword, right? He gets paid on absolute returns, not relative returns. He has no reason whatsoever to take a hit to help out his competition.
Even if
Right.
he expects that we reciprocated
I mean, that's
later
against the
when he
law.
needs
What
that?
you're talking about is against the law, and I don't think that either of those traders they don't need the capital. They would rather just go to the brokers and hit the bid wherever it is in the market. And frankly, they would rather go back to State Farm and say, I got to get out of these bonds, give me your best bid, and give State Farm the opportunity to buy some bonds at a discounted price, because then State Farm then kind of feels like, wow, these guys did me a favor. I got a bargain sale from these guys. Does that make sense?
I want to say, before you answer that, we got 40 seconds left. So I want to give Brad a chance to answer a question, and I may cut you off in the middle of your answer. So get ready. Brad?
Just real quick for the audience who haven't been in the world of ATS. When ATS is a centralized marketplace, it's sort of like eBay for bonds. And what electronic trading did was it made no sense for individual firms to solely own inventory for their own customers. They all put it in. That's what Brandeis did, and that's what Municipal Center did. But here's a nuance, and I'm delighted to talk to the author afterwards. But the nuance is we have this centralized inventory. If I want to buy a bond in that inventory, I see a price posted on a specific QSIP, and I say, and you said the average size was 70 bonds. I buy 70 bonds. How do I know that I have the best price? It's a quote montage. You have a QSIP number, and if you have 14 dealers contributing that, you get the best price. But here's the trick. You don't know who the dealer is until you execute the trade and it goes to your back office. So it's anonymous, just like the MSRB data. So the challenge you have is a great paper, but trying to figure out who these people are. But the fact that it's anonymous, I'm getting the best price, and I don't care whether it's JP Morgan, Morgan Stanley, or Goldman Sachs. So I just want to make sure that I'm delighted to talk to you after the fact on it.
Yeah, I'd love to talk.
So this has been fantastic. I'm going to make a ruling here. I think the paper's fantastic. And I think the discussion is fantastic as well. So thank you guys for coming up here, and it's now time for the second paper in this panel, a paper related to ESG. The way in which ESG is going to matter seems to be changing. I think it is going to matter going forward. So we're delighted to have a lot of environmental focus at this conference. Daniel Garrett.
All right. Thank you, Dan. Thank you to the organizers. Thank you to everyone for being here. I'm very, very excited to present this work to you today. It's called Who Labels and What's Priced? Evidence from a Third-Party ESG Assessments in the Municipal Bond Market. This is joint work with Brian Gibbons at Oregon State and Mahdi Sharabi, who is a great econ PhD student at Penn that we've been working with. So this is a really fun paper today where I want to start by talking about the recent innovation in the market. When I say recent, I really mean the last decade or two. In financial markets, many borrowers are labeling their fixed income securities to alert investors to some sort of ESG impact or risk. You've probably heard of these. They're usually called things like green bonds. Historically, the way in which these labels have been provided has been they have been voluntarily supplied by issuers, often through some sort of selective labeling. So they'll say, we're going to announce to the market we have a green bond, or we might have a very environmentally friendly project, and we're not going to announce to the market it's green bond. It's the choice of the issuer. Historically, I will argue that this market and this approach to labeling has been fragmented, inconsistent, and typically bundled with some sort of issuer-paid verification or self-verification on the part of the issuer. There are some key frictions in this, and I think this is kind of an interesting way in which this market has grown and appeared. The ESG information provision, which I'm going to call the supply of ESG-related information. When I say ESG, I mean environmental, social, and governance. And in municipal bond setting, we don't really think governance is something that they have a lot of scope over, so I'm really going to talk about transparency in the disclosures. That this is going to be shaped by issuer incentives and local politics. And that investor demand and where it's priced may be driven by all sorts of preferences, either for credible and comparable information, or they may carry, we might call it a warm glow effect. People might really like owning green bonds. And these, of course, are different forces. And so what we're going to do in this paper is we're going to use the unexpected and quasi-exogenous rollout of related to environmental, social, and transparency scores and labeling eligibility opinions on over $1 trillion of municipal debt that was rolled out on Bloomberg back in 2023. And we're going to try to ask two questions. First, are investors willing to pay a premium for the assessment and underlying ESG features of bonds as determined by a third-party verifier? This is a big question. Many of you have probably seen papers on this before. I think there have been at least 4 such papers presented at this conference in previous years. So, of course, that's not necessarily a new question, but I think we have a really, really interesting quasi-experiment that's going to give us a lot of new insight here. Second, this quasi-experiment allows us to ask a new question that has never been asked before, which is, if such a premium exists, what frictions and incentives lead issuers to under-label bonds that otherwise do meet labeling criteria? And so when I talk about ESG investments in municipal bonds, I think this is a really important topic on its own right, not just in terms of how does this tell us about labeling in other markets. But this is a primary tool, of course, I don't have to tell you all, for financing durable public investment and climate adaptation and social infrastructure in the US. So there are 3 broad categories of bonds that have kind of emerged and around which the market has coalesced. I'm going to put them in 2 categories for the sake of actually getting statistical power. So those categories are green bonds and sustainability bonds. These are going to be bonds that are financing maybe clean, energy-efficient buildings, clean energy, water, climate adaptation, flood mitigation, et cetera. They're also going to be social bonds. These are going to be bonds that are particularly not having necessarily an environmental impact, but have a big social impact. We can think of this as affordable housing, public health, et cetera. What we're going to document is what I think is a new fact and maybe is unsurprising, but academically, we're going to show most eligible bonds are not labeled. And when I say most, I mean a grand majority, well over 80%, depending on the type of label. The labeling requires issuers to self-select, and that's self-verify or hire a verifier. And the benefit of doing so historically is unclear. So I'm going to cite 4 papers in particular that have kind of looked at the muni market, and they have either done twin bond studies or they have looked at matching on observables or using institutionally driven instruments to try to get some exogenous variation in who is choosing to label and who is not. And they've come to what I would describe as some messy results, where there are some null results, there are some positive results, that maybe there is what's called a greenium, a willingness to pay more for green assets. And of course, we're also looking at a period where there was a lot of political pushback, where there were many state laws that were banning municipal entities from actually labeling their bonds as green. So I think this is an interesting time where we can hopefully shed a lot of light. So when I say labeling has not really been a big thing in the muni market, despite the fact that there have been many papers on it. So this is total issuance according to Mergent, and the share of deals that have a label. So that bottom blue dashed line is the share of bonds that have a green label. We can see in 2018 it was about 1% of bonds. By 2022, it was more like 2.5% of bonds. If we add in sustainability and social bonds as well, that's more like 5% of bonds. But a grand majority of bonds are not labeling. Now, what's cool about our data, and so I know this is probably a little small. This is a screenshot of Bloomberg from September of 2024. This is a series of bonds that Bloomberg announced. Kestrel verifiers created new ESG assessments for. And so what I want to point out is a few things about this, and I know it's too small to actually see, but you can see the things that matter. The very far left column includes little leafs and little suns for bonds that self-verify as green, social, or sustainability. And then the new information that hit the market that was kind of publicized through Bloomberg terminals starting around March 6th of 2023 is those last 4 columns where you can see there's a bunch of numbers. Some of them are highlighted green. There's going to describe an environmental impact score, a social impact score, and a transparency score. So the thing to note, look at that far left column. There's exactly 1 leaf in these 25 bonds or so that actually self-labeled. I can tell you, and without getting too much into it, about 5 of these other bonds also, according to Kestrel's opinion, qualify as labelable bonds, and they all chose not to. So the very first thing I want to describe is that selection. So Kestrel, of course, assessed a bunch of bonds, and those bonds, of course, then the scores are announced through Bloomberg. The first new fact is that almost all of the bonds that are eligible for such a bond label, so say they could qualify for a green label according to ICMA standards. Of the 2,763 eligible bonds, only 499, or about 18%, actually label as such. So labeling is not a common thing to do, even when you are funding a project that would otherwise qualify for such a label. For social bonds, it's even more stark, and we might have some reasons that's the case in our empirical analysis later on. Of the 4,500 social bond issues, and when I say issue, I mean you might call it a series or a package, only 283, about 6%, are actually labeling as social. So the first thing I'm going to do is I'm going to estimate some logistic regressions. And for the sake of time, let me just show you the marginal effects evaluated at means. So essentially, the way you can look at these coefficients is to say a 1 standard deviation change in the underlying characteristic of the bond, how many percentage points does that change the likelihood of the bond actually labeling? So we can see is a few things jump out, and I'm sorry I'm not over there in this laser pointer's not really going to show anything, so I'll just describe it. A few things jump out. The environmental benefit score. Bonds that have higher environmental impacts, of course, are more likely to label. So a standard deviation increase in social environmental benefit score, which is about 1 point on the Kestrel scale, leads to about a 12 percentage point increase in the likelihood of labeling. The first thing that jumps out to us is that there's some sort of information friction. Many borrowers don't necessarily know that they're eligible for kind of the labels. Other things that jump out. The share non-white and Hispanic, so places where you have less white population are actually much, much less likely to label. I'll also highlight that we can drop, I'm going to show you kind of 3 different specifications. So if I drop that control for environmental benefit score and I rerun this logistic regression, this is not because of a lot of variation in the types of projects across places. So if I don't control for the environmental score directly, I find a very, very similar pattern. The next 2 things I want to show you is that if I drop the share climate worry, where this comes from the Yale survey on climate concerns across space. So this is at the county level, what share of the local constituents are worried about the climate change. It's extremely correlated with the share Republicans. So the correlation coefficient on those is about 0.91 in our sample. So they kind of wash each other out. So if I drop share climate worry, we see that a 1 standard deviation increase in the Republican vote in 2020, which is about 15 percentage points, leads to about a 9 percentage point decline in the likelihood of labeling. And if I instead drop the share Republican and focus on the share climate worry, of course, we see a 1 standard deviation increase in the share climate worry. It leads to about a 12 percentage point increase in the likelihood of labeling. So what does that mean? So let's say that we take the entire US and we make the entire US 2 standard deviations more democratic. That's about 30 percentage points. How much would that actually change labeling decisions according to our model? Well, that would move it about 18 percentage points. So we'd go from 18% labeling to 36% labeling. So even though there are these frictions where we kind of can identify some things that are leading to less labeling, conditional on eligibility, they really aren't the main thing that's driving why people don't label. There's something else that's kind of going on in the background, even though we can see a lot of interesting cross-sectional variation. All right, so for the sake of time, let me tell you what we're going to do on the second question. So on the first question, we can say there's a lot of new evidence that the way in which these labels are being applied is driven by cross-sectional variation in local characteristics, particularly climate concern and political lean. But maybe there's also a sense in which, does anyone actually care about this information? So what's really cool about this quasi-experiment is we get all of this new information dropped on the market, and the issuers themselves did not make any choice over this information being provided, and the information's not provided on the whole market. So what I'm going to be able to do is I'm going to do a difference in differences analysis, where I can say, let's compare bonds that Kestrel assesses to bonds that Kestrel doesn't assess and how they trade over time in secondary markets. And then further, I'm going to do a kind of a modification to this diff and diff method where I'm going to say, let's just compare bonds that Kestrel gives assessments that they're really environmentally friendly to not really environmentally friendly, and see if that really changes how the trading happens in the markets. To be clear, we're going to control for everything under the sun. You can see the paper for kind of we're going to really saturate this regression with a bunch of time-varying controls for how bonds might trade, given that we're looking at 2021 to 2023. And we're going to be looking at kind of every month, looking at how these bonds trade, the bonds that are newly assessed relative to bonds that are not assessed, and also based on their ESG characteristics according to the Kestrel assessments. I also want to highlight that in these 3 years, I'm going to be breaking up time into 2 periods, or 3 periods. So there's going to be a pre-period where I'm going to look from January of 2021 through February of 2022. So Kestrel started getting some select institutional subscribers that started getting some of this information earlier, before it was actually posted on Bloomberg, between, let's say, March of 2022 and February of 2023, before the actual scores were posted on Bloomberg in March of 2023. So I'm going to show you a graph that shows how these pricing effects have evolved. And so this is our average effect for being assessed relative to being unassessed. So Kestrel comes out and they assess, and this is at average scores. I should note, these average scores, the average bond that Kestrel assesses is not eligible for any label. So what we see is the bonds that are assessed between, say, January of 2021 and February of 2022, they are priced very, very close, within about half a basis point of the rest of the market. And we can, of course, we have a lot of statistical power, but we can say that there's no kind of big differential trend in how these bonds are pricing. Then I want to focus quickly on the long run, which is past the solid line on the far right of that graph. In the long run, we find the bonds that Kestrel assesses have about 3.8 basis points lower spreads, and these are tax-adjusted spreads, so this is after tax, not pre-tax. Tax-adjusted spreads relative to comparable bonds on a lot of other margins. And then in this period between March of 2022 and February of 2023, we do see kind of a slow and evolving decline in these spreads as institutional investors have access to this information. This, to me, is evidence of an assessment effect, that on average, people are really worried about the uncertainty over ESG characteristics, and that this information is valuable to investors. Now, it's so that's the average. So now let's zoom in on, okay, so Kestrel also gave us actually these quantitative scores. So what if we look at those bonds that get really high E scores to really low E scores? So here I'm showing you the interquartile range. This is 75th percentile to 25th percentile. So what you can see, and I've put them around the average here. So the average is existing in the background, and then there's some spread. This is what we'll call the greenium. So this is on the margin of how green are these assets, or how environmentally friendly, how much extra beneficial pricing goes to the greenest assets. So the top red line, which you might not be able to see, it's pretty close to the average line. That's for bonds receiving an E score of 3. And the blue dashed line underneath is for bonds receiving an E score of 4. You can see this is almost exactly 1 basis point, and it only becomes statistically significant after this information is released on Bloomberg. And so if we think going from the 3, the 25th percentile score, to a 5, kind of the best score you can get, it's about a 2 basis point greenium, which is very small, but is material, and we can say it's statistically significant once this information comes out on Bloomberg. We see a very similar pattern for bonds that score high on the transparency margin. I should note these colors flip for social bonds. The most social bonds in receiving these really high scores through Kestrel and posted on Bloomberg, they don't really have a big decline in spreads. Their overall decline is only about 1.6 basis points instead of the 4 basis points on average. This is consistent with the idea that we already have pretty good information on social impacts of muni bonds, but we're really missing a lot of information on the environmental impacts. Is this big? I'm going to say 4 basis points is not big. I'll point out just 2 papers. I'll talk about this last one. Mike Schwartz, 2017 Journal of Finance paper, said that bonds that regularly trade, there are liquidity spreads of 35 basis points and credit spreads of 101 basis points. 4 basis points is really ultimately quite small in the scope of that. Is this big enough to solve our climate crisis? Almost certainly not. There's a really nice macro paper by Hong and co-authors in the Review of Financial Studies. It says you need about 140 basis point greenium. We aren't coming close to that. We aren't in the right ballpark. But I think that we are saying that investors really do care about this information, and it is priced statistically in a statistically significant way, even though it's not maybe the first order thing that's driving municipal borrowing costs. I will finish by saying there are 3 mechanisms we look into. We look at institutional demand. So several of these papers have said mutual fund demand is really what drives these effects. We look at that. We find in the short run, particularly in that period in 2022, there is some increase in purchase by mutual funds, but it's very small and it disappears in the long run. So it's not the only thing that's driving these greenium estimates. Second, we separate things by local beliefs and climate risk, which of course drives the selection into labeling. We find no difference in the pricing effects. The greenium and the assessment effect are very similar in Republican and Democratic, say, leaning jurisdictions. What we do find, and that's the graph that you see here on the right, is that for revenue bonds with credit risk that is material, so I'm going to say below a AA minus, according to S&P's scale, we find the very biggest effect, suggesting that a lot of this information on environmental and social risk is very much complementary to information about credit risk more broadly, and that there's a lot of scope for providing new and more information that investors will really care about. There are some placebo tests and some lots of things you can check out in the paper, but let me conclude by saying that this labeling decision is political. It's driven by local characteristics. We show that the pricing of these bonds with verified and underlying ESG characteristics is something that investors really do price. That is, they demand that information, particularly in places where credit risk is material. Thank you so much.
I'm Mike Paparian. I have a background in environmental policy and environmental finance. Ran a bond issuance agency for the state of California and was deputy treasurer of the state of California before I retired, and have since been continuing my work on environmental policy and environmental finance. I want to thank the organizers of this conference. I've learned a lot. I have actually shared information I got yesterday with folks who I know will make great use of it. One of the things I learned was actually in the hall. I came here on Sunday. That was, for those who don't know, that was Moon Day. And that might mean something to a lot of the schools that are listed up here, but it means something special to Purdue University, I learned, because, there you go, because Neil Armstrong, along with a lot of other astronauts, graduated from Purdue. I'm old enough to remember when I actually watched the moon landing on TV, unlike most of the people in this room. And I was living in Los Angeles. There were 7 television stations in Los Angeles at the time. That's how many television stations we get on our TV. Today, God, we get a gazillion. We have lots of choices and so forth. Although you might argue that's not better, I would argue I have more access to better information and better television as a result of what's happened. Back at that time, the offering statements for municipal bonds were probably the size of a comic book. And today they're more like the size of a phone book. If you don't know what a phone book is, see me afterwards. Again, I think the investors are looking for more and better information. And I think that that's one of the things that this study has shown is that more and better information results in actual decision-making on the part of investors about where they're going to put their funds. So I want to thank Professor Garrett and his co-authors for substantially contributing to the knowledge about ESG and the relationship to municipal bond pricing. I also want to thank Monica Reed is right there. She runs Kestrel. It's a small business. She put a lot on the line as a small business developing this scheme of ranking bonds. before she had anybody paying for that service. So she has done a remarkable job contributing to the knowledge base that's out there in the municipal bond world. I have a couple of small quibbles with the paper. They're very small. The paper is excellent. One of them relates to just the overall description of the green bond marketplace. If you want to issue a green bond, there's really no regulation about what you call a green bond. Anybody could call anything a green bond. And early on in the green bond marketplace, this happened a lot, and a lot of green bonds were for very questionable things. Investors have wised up and now are able to look more carefully. They do look more carefully at what things what the money is being used for. You can still call anything a green bond if you want to, but typically there's a continuum. You might call something a green bond. You might do okay with that. You might get some positive reaction to that. You might then your next bond, you might give some more better information about that. You might call in a third party to verify your information. You might then say, oh gosh, that worked okay. I'll pay somebody to validate that it's consistent with the ICMA standards, and then I might ultimately get a climate bond certification. I've seen people go through this sort of continuum. One of the things that this paper adds is an additional spot in that continuum. Before you label, there's something important and something very interesting, and that's something that Monica's report has added as well. So I think there could be a better description of that continuum and how it continues to be used. Figure 1 in the back of the report relates to that. The only other quibble I have is the ICMA guidelines description as being precise and quantitative. I question, and I talked briefly about this, whether ICMA is really precise and quantitative. I view it as a little more general, but encouraging of people to provide more detailed information. Again, that's a small quibble in the context of the report. I thought I would talk just briefly about some of the implications of the report. And just by way of context, and you heard that there have been other studies in this area. What a lot of them have shown, if you look globally, is that there is a premium in the European marketplace, a premium in the Asian marketplace, questionable whether there's been a premium in the US marketplace. This is showing some sort of premium happening in the US marketplace. That's an important contribution. Now, what will that mean to issuers? When I was with the state of California in the Treasurer's office, I appreciated our green eyeshade people who challenged us every time we wanted to do something that might cost more for a bond. And one of the pushbacks in our initial green bond offering in California was, oh my gosh, it's going to cost us something to put out that green bond. Well, one of the things that this is showing us is, well, no, there's actually a savings with a green bond that you need to take into effect and take into account. So with each basis point, and you guys are better than I am in calculating things, but $100 million, a basis point is worth like $10,000 for each year that the bond is out there. So it's to me, a notable amount of money. In the scheme of the $100 million bond, it might be a tiny bit. But for those who have a requirement to issue their bonds at the lowest possible price, the best benefit for the local government, that could add up when you talk about 4 or 5 basis points. And at some point, the ESG advocates or those who are concerned about municipal spending may catch on to that and question whether an issuer is truly doing what's right by not labeling a bond or not upping their score on the Kestrel score scale, because what's been shown is that that will, in fact, save the local government money. The greater greenium for riskier bonds was very interesting, that the amount of the premium for bonds that have a higher credit risk. And what that's indicating to me is that the investor is using that information to differentiate whether that bond is less risky than its comparable bond or not, or whether that local government, now ultimately the investor is most interested in getting their money back and earning their rate of return, whether that, when the investor is looking at that bond, whether that bond is more likely to pay back and give them their money back if it's got an ESG score compared to one that doesn't. And what that may be indicating is that the ESG scores are serving as a surrogate for climate risk in the broad sense. That is, whether the government has taken some climate risk into account and is considering the impact not only of that facility on the climate, but the impact of the climate on their local government. And if they have done that, then maybe they are more resilient. Maybe they are going to be better able to withstand the shocks that might come from a flood, an extreme heat event, a fire, et cetera. So as investors wade into the sort of phone book of information that's available to them, I compliment the authors, I compliment Kestrel for putting more information into that phone book that can be used by investors, has been used by investors, and has now been shown to actually have an impact on investment-related decisions. Thank you.
Dan, do you want to take a moment to respond to Mike's comments?
Sure. Thank you so much for the discussion, Mike. I think this is, so Mike and I have now had, I think, 3 discussions about this paper. You've pointed out a lot of institutional information about kind of the history of the Climate Bonds Initiative, ICMA, the relative kind of levels of what label applies where, and I think that's all extremely helpful. We will do a better job in the next version of that paper. I agree that our description of ICMA as precise and quantitative is probably misleading. I think I want to point out a few things that are in the paper. So of course the paper is quite long at this point. I think it's pushing 80 pages. The very last table in the paper right now, on the very final page, kind of breaks down our results by type of project in a way that I think is potentially interesting for thinking about these assessment effects and what are the real risks we could be looking at. So essentially we find the greeniest, so this is the pricing for that environmental impact score, really shows up in utilities-related revenue projects. The assessment effect really shows up in non-utilities related revenue projects. Think this is going to be hospitals, toll roads, airports, lots of things where most of them really don't qualify as eligible for some sort of ICMA related label. But where we think these risks might be material, and that's where we find what we call the assessment effect. So that average effect, even for bonds that are assessed and ineligible for any label, that's where we really find the big effect. And that's so I'll say, like, we find both a greenium and an assessment effect, and what I really want to highlight is that assessment effect is big. Even for places that don't qualify as green bonds, people really seem to value, or investors really seem to value that information, at least according to where we see this information around on Bloomberg and where we see it kind of being reflected in the prices. Look forward to some questions.
I want to jump in with the first question, and Mike, I'm going to put you on the spot a little bit. You work with the Climate Bonds Initiative, and I want to bring together what we've seen today with some stuff that was discussed yesterday. given the increase in prices, we've got situations where issuers borrowed $100 million, maybe with bonds that were certified by you as ex ante having a green dimension, and then if the price of the solar panels that you were going to put in place, triple, if what you were going to do is now no longer feasible, given the price and the amount that you borrowed, are you seeing situations where, for whatever reason, ex post, the greenness, possibly because of the cost of materials, is diminishing in a way where the ex post monitoring is becoming a more important topic for you guys?
Really interesting question. The short answer is no, I haven't really seen that. What I have seen more often is that the business plan essentially hasn't worked in some of the green bond and certified bond efforts, where it's for a project that presumably was going to do X and it only did 0.7X, and then they were unable to pay back the bonds. They had to restructure the project. They had to do something. So this happened with a large facility that was going to manufacture fiberboard out of recycled materials. It's happened in a few other instances like that. What you're describing, I don't think affects the greenness of the project, but affects more the underlying business plan of the project.
That makes sense. I'm going to open it up. Y'all have questions? Okay. Can you introduce yourself? Yeah, you.
Hi, Samantha Pedrosa, National League of Cities. Daniel, my question's for you. A couple of years ago, we did a series of focus groups with our member cities to understand this exact issue. And while we heard a lot about state laws and public narratives certainly playing a part, with our small to mid-sized cities, many brought up to us the short-term cost of going to Kestrel and getting the label. Or another one that was really big was staffing, because we have some city finance directors that are also deputy city clerk, city manager. They're running like 3 to 5 jobs, and they just don't have the capacity to say, here's an extra step, because this is how we've been doing our bonds for years, and we'd rather just follow what we have in place. Did you incorporate those things into your data as well?
Yeah, so we're thinking a lot about size, and so I didn't have time to talk about in our selection model. We do think that the fixed cost of crossing that hurdle of saying we want to share some information related to our environmental and social impact with the market, be it we're going to go hire a third-party verifier, or we're going to build up some internal capacity where we're going to hire extra people who kind of are able to engage with this process. We see larger bonds are much more likely to label. So I think we didn't really get to talk about it, but kind of it's in the paper a little bit. But yes, I think it's totally makes a lot of sense that small and mid-sized issuers borrowing for $10 or $20 million might not cross that cost-benefit threshold of saying we want to pay. I'm going to ballpark here. I do not know how much it costs to hire a third-party verifier. Let's say $5,000 to $15,000 to someone to actually go and verify. You're smiling.
I was reading Mike's face. I wanted to see what his face would look like when you. So he said 5.
I think that's realistic, and I think people could talk to Monica afterwards. But yeah, I think that's realistic. A very complex project, it might be $100,000. But I think most of the kind of projects you're talking about probably are more in that range, 5 to 15.
So for a smaller mid-sized project. So I think there is a fixed cost. And that fixed cost might also have some internal cost that we're not measuring as just the cost of hiring a third party. And I think it totally makes rational sense in a cost-benefit analysis for that information not to be necessarily shared by the issuer. I do think that is something that is very cool about this approach of, say, Bloomberg hiring Kestrel and institutional investors hiring Kestrel to put this information out there to a broader market without the issuers paying for it, is that it doesn't require small and mid-sized issuers to actually kind of cross these thresholds. Now, of course, where Bloomberg and Kestrel have focused has been the larger bonds, because that's what investors are most interested in paying for, is my understanding. But I think this approach of kind of the investor-paid verification is potentially very, very good. I think the main beneficiaries are going to be small, potentially Republican-leaning places that now this information is getting out there without them having to pay for it. I think is kind of a really cool thing.
Thank you.
Quick question. How do you think, Daniel, about the Berg et al. Review of Finance literature around just the disagreement in ESG ratings and just like that whole issue? So it's like a big question, but maybe I'm just curious if you engaged on that in the paper already.
Yeah, I think that's really interesting. So there is this literature in finance that has documented, there are a series of papers now, kind of documenting that within equities in particular, there are a bunch of different companies that are selling their own ESG scores at a company level where there's a lot of disagreement. I think there's actually here less scope for disagreement because we're looking at a project, not a company. We're looking at an individual bond, not an issuer. I think in fixed income, it makes a lot more sense for there to be less disagreement. Also, I don't think those papers have necessarily gone into fixed income yet. I think it's a really interesting question. I think it's forward-looking. We don't have much to say about it other than we only have one score for this $1 trillion of the market we were looking at, so we're just assuming it's right. And if more scores come out, I think it's a cool thing. You can talk to Monica to see how hard the business is. But if more scores come out, we could absolutely do something with is there disagreement? Is there scope for disagreement? We do, again, we try to break out by project type. We try to say where could disagreement exist? And is this information most valuable where this disagreement could exist? Think general purpose, general obligation bonds. There could be a lot of disagreement about how. We don't really find any effect there, actually. Really, almost all the effect is in revenue bonds with specific projects where we think it's reasonably clear that if you go and look through, say, the engineering schematics for the building or whatever the project's doing, that you're going to come up with something reasonable, I think. So yeah, I think there's a big literature there. Could be interesting here. We don't have much to say about it. Thank you.
I think we have time for one more question. And if you could introduce yourself too.
Hi, Paul Kincher from Texas LBJ. Could you talk a little bit, and did you see, were you able to characterize the investors that are actually paying the greenium? Or are there swaths of investors who won't because they're worried about having to justify paying that greenium?
That's a great question. So we are using the MSRB transaction data for academics that goes up through the end of 2023 right now. It does not tell us who the investors are. What we do is we use the EMAX data, or the CRISP mutual fund holding data, where we can see a lot of institutional investors and say who is getting in, who's getting out. We don't see systematic movements on any of those margins with, say, who's moving it. So there's some movement into these newly assessed bonds by green labeled mutual funds. But that disappears in the long run. That disappears by kind of 2023 when this information actually comes out on Bloomberg terminals. So unfortunately, we don't have as much to say about these investors as we would like, because I think that's where a lot of the recent literature has focused in saying there's certain types of institutions who have made certain types of claims, and they have to hold to those claims, and that's what drives demand for these bonds. We don't really see that. So we can show just by the quantities that each of these mutual funds are holding, that's not where the action is.
And I think one of the questions that the paper raises is this being used as a indicator of risk, regardless of what the label says, ESG? Is it something that's indicating risk, so the investor is willing to take a slightly lower rate of return in order to have more confidence in the riskiness?
All right. Thank you to the authors, the discussants, and thanks to y'all for very great questions. So on. But we've got a 10-minute break now, and so let's reconvene here at 9:55. That was fantastic. Good presentation. Hey, Mike.
Sorry.
That was a great.
Great. All right. Hello. Welcome back. So for our next session, we're going to start off with Jess Cornaglia from Penn State. He's going to talk to us about what bond yields and local government finances can tell us about unauthorized immigration. And that'll be followed by a discussion by Wendy Edelberg from the Brookings Institution. So Jess, the floor is yours.
Okay, thanks very much, Christine. And thank you very much for to the conference organizers for including our paper on this program. It's really a privilege to be here. This is unauthorized immigration and local government finances. It's joint work with Kimberly, who's here today, and our longtime friend and co-author, Ryan Israelson at Michigan State. Okay, so the title, I think, is this is a Muni conference. I imagine you all kind of already know what we're trying to get at here. So what is the relationship between this recent focus that we've been having in policy circles on unprecedented, unauthorized immigration, and what is it doing to local economies that are absorbing immigrants? Now, the first thing I want to say is the rhetoric around this kind of immigration is very polarized, as you know. People that are in favor of deportation will use the phrase illegal immigrant or illegal immigrant. People that are more in favor of keeping people in the country and not deporting would use the term undocumented. So we're using unauthorized we're trying to walk the tightrope, but really the appeal to authority here is that the previous administration and all the data that we're going to be using use the term unauthorized. So we all know the kind of immigration we're talking about here. You pick your descriptor. Okay, so I'm sure you all have heard a lot about this type of immigration recently. Toward the end of 2023, there was so much of this that Border Patrol agents were apprehending 10,000 people a day, right? And that was a big part of this is why we got our current administration. There was so much focus on this issue. So in our data, what we're going to be looking at, this is the first time I've seen these data used really in this kind of context. Anytime someone is apprehended, they are given a notice to appear in court, an NTA. And the Syracuse Transactional Records Access Clearinghouse aggregates all of those NTAs, and we're going to be using them to measure the flow, or to project, rather, the flow of unauthorized immigration. Now, in contrast, legal immigration has been relatively stable through time. You can see there's some volatility, but call it about 1 million legal immigration residents coming in every year. So our question, as you all can assume, is what is the effect here on the local economy, in particular municipal finances? So there's a vast literature, an old economics literature that goes back decades on the economic consequences of immigration, most of which is studied as legal immigration. And the consequences, the literature has shown repeatedly, are almost unanimously positive in a normative sense. Legal immigrants on net create jobs. They are entrepreneurial. They innovate. They improve total factor productivity. One of the cool things about this literature that I've seen that I like is that it increases international trade. So the idea there is you bring in legal immigrants, they have their networks to their contacts back in their home country, and that facilitates international transactions. Kind of cool. So it's possible that the unauthorized immigration that we're going to study is going to have a very similar effect to the well-documented positive effects of legal immigration. On the other hand, though, there could be strain on local public resources that have to absorb these immigrants and come up with ways of taking care of them. And that's what we've seen a fair bit of in the news recently. You can see here in the New York Times, more cities are feeling the strain as migrants move in, seeking better prospects. And then on the right, from the Wall Street Journal, migrants stretch resources in cities near and far from the southern border. Okay, so in the interest of time, I'll skip over the data sources. We've got a lot of different data sources brought together here. These will come up as I go into the analysis a little bit more. All right, so estimating the relationship between unauthorized immigration and local government cost of capital is challenging for at least two reasons. So the first main challenge is measuring unauthorized immigration, right? People that are in the country without legal permission, they don't like to disclose themselves, right? You inherently have this issue of undercounting. And if there's time today, I hope to talk more about why I think this issue of undercounting, if anything, is going to lead us to understate our results. But that's definitely an issue. So what we have here is, to my knowledge, the most comprehensive data on illegal crossings into the United States. And this comes, as I say, from the Syracuse database. And you can get a sense for what the data are provided there from this snapshot. This may be a little bit small to see, but in that first column under the time series, we can see the nationality of the person entering the country. The middle column there is how long they've been in the U.S. at the time they're given an NTA. So we can, from that information, figure out when they first came into the U.S. And then, right, and then in the far right column, you have the month and year when the NTA was dated. So we know when it was issued. So aggregating all this information, we can get a pretty good idea of how many people came in, from what country, and to what county they went. Okay, now the second challenge here is, it's a little bit nerdier. It's a little bit more statistical, and that is identifying the effect of immigration apart from what we would call selection effects in economics. In other words, immigrants come into the country, but they don't choose where to go at random. They don't choose when to come in at random. So, as you might expect, immigrants are attracted to areas where there are good economic opportunities. So imagine, just in a naive setting, you have a lot of immigrants coming in where the economy is good. If you just stand back from that and don't do anything to adjust for that selection effect, you're going to get the apparent relationship of immigrants coming in and generating positive effects in the economy, when in reality it's the economy that has attracted the immigrants. So we've got to figure out a way to address this issue. So we do this in two steps. The first thing we do is we model immigration with what we're calling push factors in source countries. The second thing we do is we're going to use what's called a shift share instrument, and I'll talk about how this works as we get to it, to predict where these folks are going to go based on pre-existing population. So imagine you're coming into the country from a foreign country. Are you likely to go to any county in the US at random? No. What we can do to help predict where you're going to end up is say, look at the pre-existing distribution of people from your home country. If you're from, say, Guatemala, you're more likely to go where there's already a community of Guatemalans, right? So we're going to use that information in step 2 there. And this is a pretty standard approach in the immigration literature that people have been doing, again, literally for decades. So the first step here, though, this is novel. This is going beyond what we see in the immigration literature. So the way to think about this is there are, let's say, reasons why people leave their home countries. When we were first starting this project, we had the idea of, let's look at political upheaval in a certain country here. Let's look at a natural disaster in this country over here, to use those as shocks to the supply of people leaving the country and coming to the U.S. Let's cobble together this set of events that would explain a bunch of people leaving their home country and coming to a different country. That's one way to do that. What we're doing here is similar to that in spirit, but it's more, or I would say it's less ad hoc. So we're looking at things from countries like, what is the death rate inside the country? What is the GDP growth, inflation, all these other measures that we can get from the World Bank at the country year level. And so these sort of factors will explain outmigration. Most of these make sense, as you would expect. If, for example, you look at death rate, a positive death rate, whatever's going on there, it's not good. People want to leave. They want to get out. The one that might seem a little bit counterintuitive would be GDP growth. You get higher GDP growth, you get higher outmigration from source countries. One way to think about this, though, is you need a baseline level of wealth to oftentimes get out of a country. There's research, the best study I've seen on this looks at outmigration from Ecuador, and they say that for a typical Ecuadorian, they need something like 8 times their annual wage just to be able to afford to leave Ecuador. So you need some wealth to get out. Okay, so this is the first part. This is modeling out migration. We do this, we fit this model, we use it to say, okay, how many people do we think are going to leave a country based on this set of factors? We then pair that up with this shift share instrument that I mentioned. So I'll get into the details here in a moment, but what you can see here on the left and right are using the Census American Community Surveys data. These are the foreign-born populations. And then on the right, you have our NTA data, where folks are showing up at the county level over the same time period. And you know, the pictures aren't identical, but they're certainly very, very highly correlated. So we validate our approach. This, if you'll forgive me, takes a little bit of explaining. So what we're doing here is we're saying, all right, we have this shift share instrument. Does it actually make sense? So what we have here on the y-axis here, the vertical axis here, these are the actual immigrants from country of origin and county of destination. And on the x-axis, we're trying to predict where those folks come in. And there's two things going on here. There's the total number of people that are coming in from a given country, that's the unauthorized immigration piece, interacted with that shift share measure. In other words, the foreign-born share, that's FBS, from that same country in a given county from the previous year. So you've got a county, it's got some distribution of Guatemalans, let's say. You have a certain flow from Guatemala, you interact those two, that's going to give you a prediction of how many folks are going to show up in that county in that year from Guatemala. That's the prediction, that's on the X. On the Y is what we actually see in the NTA data. And you can see we get a very strong positive relationship. So here, to be clear, we're not actually using the number of immigrants. We're using this projection because we want to get away from that statistical selection issue. Okay, so main results, I apologize, this is way too small. Yeah, I'm going to expect all of you to form a single file line, come up here and look at each of these coefficients. No, so in the full sample effect, we don't see a whole lot. We're comparing within a month, a calendar month, top versus bottom quintiles of projected immigration. You don't see much. You see a few scattered positive coefficients suggesting that more projected immigration means higher muni yields. But what's really important in the immigration literature, if you look at the literature, I would speculate something like a third of the entire immigration literature is focused on labor market conditions, right? The key issue or core issue oftentimes with immigration is what does immigration do to labor market opportunities for the native population? And so what we do is we try to categorize the labor markets of counties across the U.S. And we form a proxy, we're calling it a structurally tight labor market. It's a combination of two criteria. First of all, you have to have a low unemployment rate, okay? So what that means is that people, if they want jobs, they can get them, low unemployment rate. But you have to have low labor force participation. So in other words, the people, the native population inside the county are not participating in the labor market for whatever reason. So there's plenty of jobs, but the local labor market participation is low. So these are the kinds of places where there's a lot of opportunity for people to come in and work if they're so inclined. Okay, so when we do that, that's where we get more interesting results. Now this is even smaller. So just ignore the table, and just, I'll tell you what's going on here. So we have our what we would call a typical labor market county, and we have these, call it tight labor markets, where there's a lot of opportunity. In typical labor markets, we see that predicted immigration, unauthorized immigration, explains higher municipal bond yields. In the tight labor markets, though, it explains lower municipal bond yields. So this is a sort of, if you ask an economist, what is the effect of X on Y, most likely, if they're thoughtful, they're not going to give you one answer. They're going to say it depends. And that's essentially what we're showing you here, is what is the effect of unauthorized immigration on the cost of capital for municipal issuers? Well, it depends. If you have a typical labor market, you're going to see higher cost of capital. But if you have a tight labor market where there's unmet demand for labor, you're going to get a lower cost of capital. Okay, we also look at sanctuary jurisdictions. We find a similar result. If you're a sanctuary jurisdiction, the predicted unauthorized immigration predicts higher yields. Here's where things get more interesting. So what we're doing here is we're looking at, all right, you have predicted unauthorized immigration. What happens in the next time period? And so here, our dependent variables are things like next year's unemployment, next year's labor force participation, and next year's tightness of the labor market. And so what you see is unemployment rates go up in tight labor markets and in sanctuary jurisdictions. So what does that mean? Well, it means that if you have really low unemployment, you might have the way to think about this perhaps is that your unemployment is, imagine a benchmark, your unemployment is too low, right? You have unmet demand for labor. So the increase in the unemployment rate here can actually be viewed as a good thing, getting closer to the economically friction rate of unemployment. You get more labor force participation, that's the center set of columns, and you get some relief on that tightness measure. Okay, so the last thing that I'll do here, running out of time, is we look at cash flows, we look at revenues and expenditures. We see some evidence along a variety of metrics that unauthorized immigration predicts greater expenditures in terms of welfare outlays, capital outlays, education, a bit of evidence on law enforcement, but we don't see much evidence that these are offset with higher tax receipts. Okay, so I'll conclude. What we have here, I think, is, I hope, important to issuers of municipal securities, but just broadly speaking as an academic, I think the bigger contribution here is to the immigration literature. It's a big literature, it's old. Shockingly to me, there's not any work on immigration and cost of capital for municipal issuers. I think we're filling a rather large gap with this study. So yeah, that's my story. I'll stop there, and I look forward to Wendy's comments. Thank you.
So hello, I'm Wendy Gelderberg. I'm a senior fellow in economic studies. I'm so grateful that I was asked to discuss this paper. I really enjoyed digging in, and it gave me a ton to think about. And I think you're absolutely right that this is the first paper actually thinking about the relationship between immigration and the cost of capital. And I found that super interesting. Obviously, incredibly important and timely topic. I'll take a small detour here to just discuss what I think is incorporated into your bucket of unauthorized immigration. So when you think about what's happening 2022, 2023, 2024 with unauthorized immigration, that includes a lot of people, just tell me if I'm wrong and what's included in your bucket, who step foot in the United States illegally, and they meet somebody at the border, and then they say they want to claim asylum here in the United States, and they go into a process. So they effectively came into the country illegally, but they are now, as in a process and can even apply for a work permit. This is way less of it. Their data goes from 2009 to 2022. This is probably not particularly an issue between 2009. Oh, wait. We exclude asylum seekers. You assume, you exclude them. Fine. Okay, great. But nonetheless, great. But also, if you're thinking about the most recent episode, that all really starts in 2022, which is just the last year in their data. They have created an amazing data set. Reading about how the data set they put together made me really tired. And I did not have to do it. This is a really novel approach, as I said, to assessing the effects of immigration on local government fiscal health. There's been a lot of thought about what happens for different kinds of immigration with regards to spending, with regards to revenues, but not how market prices might reflect those effects. That was super interesting. And a really intriguing approach to measuring local labor market conditions. I found this interaction between low unemployment and low labor force participation super interesting. Excuse me. Okay. I'm glad you didn't do this because this gives me a little bit of value added. These are some key estimates as I calculated them from Table 5, which is their main results. The differences in bond interest rates, or the spreads, but effectively then the bond interest rates because the benchmark is the same, relative to an issuer who's in the first quintile of immigration in this category. So that's the benchmark group. And that first quintile of immigration and normal markets, so not structurally tight labor markets. So just to give you a sense of how big these effects are on interest rates, for all issuers, all bonds, fifth quintile relative to the first quintile in normal markets, it's 4 basis points. That's not, I'm going to argue right now, a wildly huge economic effect. That's pretty. So if you think about it, the standard, they report this in the paper. The standard deviation of these spreads is 70 basis points. So 2 times standard deviation, 140 basis points. So 4 basis points, it's not explaining a huge amount. And it may, as far as an issuer is concerned, be sort of in the noise. But some of these definitely aggregate up to be economically significant. So for example, city revenue bonds, fifth quintile relative to first quintile is 10 basis points. Now, as he said, as just described, then the effects flip if you're in a structurally tight labor market. And here, so for example, city general obligation bonds, fourth quintile relative to first quintile, you have a reduction of 5 basis points. The county revenue bonds, fifth quintile relative to first quintile, is a reduction in 13 basis points, but I want to come back to the revenue bonds in a second. The other thing I'll say about, two other thoughts on these numbers. One is, do keep in mind that I think fifth quintile relative to first quintile, those are really different worlds. So, this is not, I can't imagine a city like actively saying, let's shift ourselves from being a fifth quintile to first quintile locality. That's a big change. That's my intuition. The second is I wanted to think about how big these effects were relative to other things in the big table of explanatory variables explaining spreads. How big these effects were, and did I sort of understand these orders of magnitude? And to be kind to the reader, they don't give all of the coefficients in every table. But so I don't have all of the coefficients for Table 5, but I do have all the coefficients for Table 4, where they don't separate out between normal markets and structurally tight labor markets. And there, so for example, they give the coefficient for median household income. And it makes perfect sense that if the median household income is higher, that might result in better interest rates in capital markets. So my reading of their coefficients is moving from the 25th percentile, where you have a $55,000 median income, to the 75th percentile, $81,000. It's a big change. The spread changes by 8 basis points. So if you had asked me, just my intuition before looking at these coefficients, which number was going to be bigger, I would have thought household income. Like I just would have thought that that municipal bond markets would just kind of look at household income and assess interest rates, kind of like really, really rich localities should get much lower interest rates than really wealthy localities. I completely appreciate there are lots of other variables on the right-hand side that are highly correlated, but nonetheless, I was struggling thinking about how all of these different coefficients in Table 4 mattered. I don't know the coefficients in Table 5, so it could be that I'm being led astray by looking at Table 4. Okay. But anyway, I found this, I loved digging into into this. I found it super interesting. So I don't think you talked a bunch about what the fiscal pressures are behind these different spreads, but there's a bunch in the paper on this, and really interesting results. They look at how revenues are different in these different localities, and in a regression setting, and how spending is different. In revenues, interestingly, they find no significant effect on total revenue, total taxes, or property taxes. I found this a pretty surprising finding, in particular that unauthorized immigration lowers aggregate sales taxes. My sense is they found this puzzling too and said, maybe it's because the more unauthorized immigration you have, the more things are done in cash. But nonetheless, I think that shouldn't lead to a lower effect on revenues. So that surprised me. On spending, unauthorized immigration significantly increases local government expenditures across multiple categories. I found these results super interesting and super useful and made a lot of sense in terms of motivating why bond markets were responding to different kinds of immigration flows because those were putting spending pressures on these localities. So next step, what I would love to see is, do the specific localities that increase expenditures actually experience higher bond rates? So they can actually, and again, appreciating that there's a lot of, there's a lot of other things that matter for bond rates. They have a panel data set. They've put together this amazing panel data set. They can actually look at how localities, and they're using fixed effects, right? So they're really getting, the explanatory power is really on changes within a locality, I think. And so you have a specific locality that is, let's say, seeing changes in its immigration patterns over time. Do they also see changes in expenditures over time? And does that result in changes in interest rates in bond markets? I get it that regression analysis is meant to tease out the marginal effect, because there's so many different explanatory, a lot of things go into mattering for bond rates, but I would still have loved to see just a few case studies of, here's a locality that experienced more immigration, higher expenditures, and they were penalized for that in the bond market. And then the flip. And you could test this all directly. So very quickly, please conclude. Okay, so very quickly, I would love more information about the sample. It looks to me like only half of the observations actually have bond income. This is a really difficult data set to use, and I commend them for understanding it, but it looked to me like, anyway, some counties have no bond data in any year, so no interest rate data in any year. That was my reading of the data. And then, so how many counties actually have changes in immigration over a period when they have bond income? Tightness, you said structural tightness. That made a lot of sense. This is not, don't think about this as a business cycle tightness, but how much does it vary over the years? I think it's pretty sticky. And indeed, I couldn't look, I could, but I didn't, look at the interaction between unemployment and participation rates, but I could look at unemployment relative to the national unemployment rate. And this is the distribution of counties by percentage of years with the unemployment rate, their unemployment rate, below the national average. And you can see that it's very common for counties to either be stuck at lower unemployment rates or higher unemployment rates. And so we're really just getting the explanatory power from these, this set of counties that are moving in between. So again, love to see more about the data set. Thanks.
Okay. Thank you. So let's start with Jess, if you want to respond to anything there.
Sure, please. Thank you so much, Wendy. Very helpful and constructive comments. Maybe just a couple things. I'll go in the order.
Start with anything I got just wildly wrong.
Okay. Yeah, nothing on the list.
Okay.
So, yeah. So in terms of the magnitude effects with there's a lot going on that these comparisons potentially mask. You know, if you think about like the state of Illinois, and you think you have parts of Illinois with high household income, you have parts of Illinois with low household income. Which of those two parts do you think has the higher cost of capital? So my point is that it's not strictly the case that higher household income is going to have a lower cost of municipal finance, because there's a lot of other stuff going on. You know what, I'll leave it at that. Point's very well taken. There's more we can do to, I think your comment about getting into the areas where we actually see these higher expenditures, is that where we're seeing the changes in the bond yields? Very well taken. You know, the missing observations in the data, we can do more to explain that. Of course, no data, we can't run anything, so we are hamstring there to some degree. And yeah, absolutely, we should do a better job of describing the stickiness and unemployment measures. Thank you.
Great. Okay, so while we get microphones to, I think there's at least 2 questions here. Let me just ask you a quick one. So I think your instrument is capturing increases in unauthorized immigration. I wondered what you think you might find if you looked more recently at some of the reductions in unauthorized immigration. Do you think your results would flip?
That's a great question. You know, I would guess, and it's just a guess, you know, we can't say for sure in the paper, but anytime you have a labor market in equilibrium and then you yank it apart, that's going to create volatility, and I would imagine that that's going to be disruptive to the local economy, and there will be an adjustment period. Maybe over the long term, the native population is made better off and your muni yields come down, but I just can't, it's difficult for me to imagine deportation events having a short-term reduction in yields on new issues. I could be wrong. It's an empirical question, but that's my sense.
Can I jump in and just to offer one observation that actually, so the most recent changes in immigration in 2025 are actually more on the inflow side. So we've seen very sharp reductions in people crossing the border. So unauthorized immigration inflows, I mean, they're not at 0, but they're darn close.
I think Angela, you're first.
I thought this paper is really interesting. I think it's paralleling your opioid paper from before, honestly. I had a couple of comments. One thought was you have a table on unauthorized immigration and structurally tight labor markets. Any thoughts on structurally tight school districts? And I'm thinking that because I live in a sanctuary city and we're bursting at the seams, and it precedes some of the spending effects. So the enrollments have shot up, and there's a lot of really interesting school district data out there all over the place. So there's a lot of ways you can maybe measure it, but that's what's going on with us. So first we had a flood, then they put these little, pod things to put student classes in, and now we're doing the construction, so it kind of precedes it. The second thought I had was with regards to the revenue side, any thoughts on looking at federal grants? Because, and I'm not sure how this would work. To some extent, it might be paralleling your measure itself, the unauthorized, or the sanctuary city measure, but it might not. So, for example, this could be direct grants, and it could be indirect. The grants might precede the flow of immigration, and they might be in response to it. So it's got some tension to it. Also, you could have indirect and direct effects. So if you look at some of the nonprofit effects, they're getting grants as well. And again, that might precede it, it might ex post it, I'm not sure. For example, Catholic Charities, they're well known for helping facilitate the unauthorized immigration. So some of that could be to the sanctuaries, but quite a bit of it might not be. So again, I think that might be kind of fun to think about looking at.
Yeah, no, great comments. Thanks a lot, Angela. Yeah, I totally agree. There could very well be variation within different types of issuers. You're talking about school issuers. They almost certainly face unique pressures relative to I don't know, stadium bond. Things are just going to be different. That's a great comment. We can definitely track that down. In terms of federal grants, that's a great comment as well. It could turn out that federal grants are a pull factor that attract immigrants. We have some data on intergovernmental transfers that we can use, I think, to get more closely at that question. So, yeah, very good. Thank you.
There's a question in the front here. Please
Very
say your name
interesting.
and where you're from as well.
Luis Lopez, University of Illinois, Chicago. Very interesting work. I think it is surprising that you find the cost of credit increasing with unauthorized immigration, because yesterday we just learned that cities want to grow, they want more people, and many times these individuals, if using the words of Daniel Soto, a labor economist, they're extra legal because they are doing jobs that maybe haven't gone through the bureaucratic process or the red tape, right? Many of them are entrepreneurs, creating new businesses, right? They're consumers, right? So then they're creating a lot of economic activity. So then to me, it's a little bit puzzling that why is it a greater cost onto the city? So if they're generating revenue in terms of taxes, because they're consuming, they're working, they're paying taxes. You get an I-10 number. That's how they pay taxes. But so then that makes me ask, well, is it that the federal government is not recognizing that these individuals are moving into the city, and now the federal government is not providing the state government sufficient cash flows for the schools, the hospitals, and so forth, because we have individuals producing money, but maybe the federal government's not providing enough back to the states. So then the next kind of comment is that, okay, well, let's just take the results as given. What can be done? Is it that cities need to get rid of undocumented people? Or is it more that, no, we got to translate them and get them through the bureaucratic process and make them either residents or citizens, because there's money on the table?
Mm-hmm.
So I'll just leave it at that.
Yeah, sure. I think one of the key points of the paper is that there's heterogeneity in the effect. In some labor markets, as you're suggesting, the effects are very positive for the local economy. We heard in the mayor's panel yesterday in Findlay, Ohio, that's the kind of place where there's unmet demand for labor, and that can be a good thing if those people come in. But ultimately, it's a question of value provided versus value required to support the inflow. Research that I've seen on this with respect to only legal immigration suggests a positive multiplier. So the ratio that they compute is jobs created to jobs taken, essentially. And the best estimate I've seen on legal immigration is that multiplier is about 1.4. So there's 1.4 jobs created for every legal immigrant. This is a different style of immigration. And ultimately, the question empirically is that multiplier larger than 1 for this type of immigration? And what are the cross-sectional characteristics that make it bigger than 1 in some places and smaller than 1 in others?
Can I jump in because I think that one of the reasons that I was invited to do this is because I co-authored a proposal with Tara Watson to actually transfer some of the fiscal largesse that the federal government enjoys from all kinds of immigration to localities that are particularly fiscally burdened. And part of the issue is if an immigrant comes to the United States with children, legally, the locality educates those children and just bears that cost. And if that immigrant also happens to be lower income, have less formal education, they're more likely to need other services, and those costs happen right away. And the tax revenue that you're talking about accumulates over a long period of time, and that immigrant's children is probably going to grow up to have higher income. So all of that is a long period of time. So there's a big mismatch. And so it makes sense to me that even if an unauthorized immigrant creates more GDP, the locality is feeling a fiscal burden. And it makes sense to me that fiscal burden is going to show up as different interest rates in capital markets. I mean, it should.
Okay, so I think we have to call this one because we only have 8 seconds left. So the rest of the questions we can take offline. Thank you so much to Jess and Wendy.
Thank you, Wendy.
Okay, so our next presentation is going to be about how labor market mobility influences the trade-off between raising taxes and raising debt. Our presenter is going to be Xiaodan Gao from Renmin University of China, followed by a discussion by John Giamarino from the University of British Columbia.
Good morning, everyone. I would like to thank the organizers put our paper on the program. And this is a paper joined with Paul Gao at Notre Dame. And in this paper, we try to understand how cities adjust their tax and debt when they in response to labor migration. When I started this project, when we saw a gap, so empirical studies on muni bond or muni finance have been growing really fast, but majority of them lack of theoretical foundation. And recently, only a few papers try to address this gap, including my discussants paper, like Carlson et al. 2024. In public finance, we have a well-established series regarding the trade-off between debt and tax financing. So we have regarding equivalence, we have tax smoothing hypothesis. However, as pointed by Barrow in his 1979 paper, those series ignore the migration. So in other words, but they also mention that migration is a very important consideration for local government. And meanwhile, in urban economics, they study tax policy as well as the migration choices, but they ignore debt financing. So in this paper, we try to put those 3 key elements together. And we try to address in the following question, how does labor migration influence municipalities' tax and debt financing? And we try to answer the question in a way of like macro finance. So we first will document what happened in the data. Second, we propose a model or propose explanation for the phenomenon. And also we're gonna test the mechanism, the story we tell. And also we try to show the policy implication of our model. So let me briefly summarize our main results. So first, empirically, we show if there is an increase in working age population, it will lead to a higher tax rates and a lower reliance on debt balance or debt reliance. And theoretically, we build a model. And our model suggests that a lower tax sensitivity of mobility will explain the pattern we document. So let me give an example. So suppose you are the mayor and you decide, say, whether I should raise a tax. You face 2 extreme cases. The first one is very elastic tax sensitivity of mobility, which means when you raise the tax rates, all people choose to leave. So you have high tax rates, zero tax base, you have zero tax revenue. So in this situation, probably we feel it's not a good idea to raise tax and use tax to finance expenditures. But in another extreme case, you have very low tax sensitivity of mobility. So you raise the tax rates, everyone wants to stay, no one leaves. So you have higher tax rates, no change in tax base, so it will lead to a higher tax revenue. So given the, let's suppose given the expenditure, the investment, then you have a higher tax revenue, then you have lower demand for that financing. So that's pretty much our story. Then we also test our story. We group our cities based on the degree of labor mobility. And we show that the main empirical findings we document is driven by the cities with low labor mobility. And also we have some policy implications, but given time constraint, I will skip for now. So what are the contributions? So we make 2 contributions. So first one, we construct a panel data set of over 1,000 large US cities. So our data is collected from the Annual Comprehensive Financial Reports from 2008. So we are able to leverage this unique data set to document those financing patterns for municipalities. Second contribution will be the model. So we build a model to explain the pattern, and also hopefully our model is able to guide future empirical studies in this area. So before we show our findings, let me show the coverage of our sample. So here I plot those cities on the US map. So the green dots represent the cities in our sample, and the size of the dots will represent the population. So you can show there's a large diversity in terms of city size and location. So this ensures our sample is relatively representative. Then here are the results. So first, we need to document how the migration influenced debt and tax financing. So the key variables we construct are as follows. So first, for leverage ratio, we follow the national level leverage measure. So they use debt over GDP ratio. So similarly, we use the debt over personal income. But we understand the concern, so we do some robust checks we will show later on. Second, we use the tax is measured by the tax millage rate, which is basically the property tax rates imposed by the city. Labor migration is measured as the changes in working age population. Then we run a 10-year first difference specification, and let's see what do we find. So after controlling for the city level fundamentals like tangibility, liquidity, size measured by assessed property values, we find a higher working age population will lead to a lower leverage ratio. And this result is consistent when we try different leverage measures, for example, like debt over total revenue. This is often used in municipal finance literature. And also we try different like migration measure. How about using population instead of working age population? Results are similar and even stronger. And we also try to address endogeneity, but we got consistent and very robust results. Second, we show what happened to the tax rates. So here we find use both ORS and IV approach. We find higher working age population is going to lead to higher tax rates. So our findings are relatively interesting or surprising because we often view like tax as like a burden. Tax will lead to some like distortions. But we find in some situations, well, cities prefer tax financing. So next we propose a model and also explanation. So our model follows or basically borrows from dynamic corporate finance literature because we see some similarities between the two entities, corporations and municipalities. So they both try to maximize a certain group's utility. For example, for firms, they maximize shareholders' value, while for municipalities, we try to maximize the community welfare. They both invest, they both have some operating costs. They both need to finance, right? For corporations, we have debt over equity financing. For the municipalities, we have debt and the tax. And for the shareholders, they purchase shares, then they get dividend payments in return. But for our municipality, like local residents, they pay tax. But they also get some benefits by like access to infrastructure, services, as well as maybe sometimes we gain payments, like transfer payments. So you can think of this like subsidies. So child care subsidies, for example. So we do see some similarities. So we borrow the model from corporate finance. So here are the key model features we need to generate our, give our story. We have so many features here because we need to match the moments. So we want to make our model look very similar to the data in every aspect. But here I highlight the key ones we need to derive our key implication. So here's the assumptions we need to make is the following. First, municipality values a total utility of local residents. And this utility gain from, first, infrastructure, second, from transfer payments. Second, there is endogenized population or working age population, but it's interchangeable in our model. So population is determined by, first, local economic conditions like job opportunities and local infrastructure, and last one, most important, tax rates. So here I highlight the parameter theta in red. This one is elasticity of tax elasticity of mobility or migration. And it will determine our optimal tax policy. Then the third assumption we need to make is to finance operations and investment, they use a mix of debt and tax. So here are the key model implication. Then we write down the problem, and let me highlight the transfer payment in the model. So what's a transfer payment? This is basically, in our models, is a difference between money collected by the government and money spent by the government. So if there's any remaining funds, it will be distributed from the government to local residents. That's the transfer payment. But to make our model easier to solve, we also allow E to be negative, which means in some situations, the government might raise funds, again, temporarily, from our local residents. But this is very costly, so we impose a large cost on that. And we want to make sure this situation do not happen very often. So then we write down Bellman equation, we solve the problem. Here's our first order condition optimal tax policy. So as economists, we compare the cost and the benefit. Then we determine what's optimal level. So what's the cost of raising tax? So this is a show on the left-hand side. Basically, in our model, raising tax will lead to migration, lower population, or lower tax base. So the total utility we gain from utility will drop if you raise tax. That's the cost. What's the benefit? Or maybe raise the tax rates, I'm able to collect more tax revenue. But that depends. It depends on the theta value. So if the theta is very like -5, -6, then it's not a good idea to raise tax because higher tax rate will lead to a lower tax revenue. Only if the theta is very small, close to 0, then higher tax rate can generate higher tax revenue, so there is a benefit of doing so. Then balance the two will determine what's optimal tax. Then our question is, well, what if you face a higher population? So you have a population inflow. What will be your response? So you can show on the right-hand side, I spell out the marginal benefits. You can see N here is a population. So if there is exogenous increase in N, you will making the benefits of increasing cash flow very large, right? So cost does not change much, but when N increases, when population increases, it's driving up the marginal benefits. So you are going to raise your tax. So that's pretty much our story. So then we parameterize our model, and we do find in the data, it indicates that the tax elasticity of population, working age population, is very close to 0. So it's insensitive. So our story goes through. Then what I do next is, here is a quantitative simulation of our model. So we can show when there is a shock, positive shock, population will increase, which is last right panel. And what happened to other variables? We see an increase in capital expenditure. We have a decline in leverage. We have increase in tax rates. So our model is able to generate the patterns we document. Next, we want to do some kind of policy implication. So we want to see if our model, after parameterized and validated, is able to predict the actual cases in reality. For example, we focus on Janesville. Janesville is a very interesting case in the sense that in 2008, it was in financial distress because of 2008 GM plant closure. But after 10 years, we found it's well managed and survived. So the question is whether our model is able to replicate their policies. So here we're focusing on 2 lines. One is the data, which in black dashed line. That's what happened actually in reality. And also, what's the model implication? So here we're focusing on the pink one with diamonds. So we can see after 2008, what happened in Janesville is we both predict higher capital stock, lower leverage ratio, and the fluctuation in tax rates initially decline, then it's moving up. Then also we have higher income and the fluctuation in population. So we found our model predictions can closely match what happened in Janesville. Then what's the story? So in financial distress, what should we do? What's the policy implication? So our model suggests that you are supposed to get funds from elsewhere. In the model, we just assume because they're reverse transfer payment, so the city can declare emergency and collect funds temporarily from the residents. So that's the source of funds in our model. And then you can create space. You can cut the tax. You can lower the debt, but you still have funds to finance infrastructure investment or expenditure and other operating costs. So that's our model predict. But what happened in Janesville? They also have higher capital investment, lower debt, and initially lower tax rates and tax rates going up. What's going on? Where the money comes from for Janesville? So I read through those documents, and I find they also have an early fix. So in 2011, Janesville did a revaluation, citywide revaluation of those property. In this way, so in the documents they mentioned, hey, this year we need to increase tax revenue by, say, 3%. However, they don't want to raise tax rates. So what they did is they did a revaluation of local property. So the value, assessed value increased by 9%. In this way, they can create a cut in tax rates. So why is this important? Because cutting tax rates and also leverage is able to help you to create space for future fiscal policy. Yeah, that's pretty much what we have. So basically, the idea is, if you face a financial distress, intervene earlier, then you find a way to get money to lower your tax rates, to lower leverage, to create space for future sustainable fiscal health. In time, I will stop here. Sorry, one more slide to show. So we test our story. So our story is about the sensitivity of mobility. So we group the cities based on their workforce mobility. Here we show those pink ones are the cities with low labor force mobility. Those blue ones are the high workforce mobility. Then we run the regressions. And we found that, indeed, for the cities with low local labor force mobility, the results are stronger. We found higher working age population will lead to lower leverage, higher tax rates. But this effects, or this finding is much weaker for cities with high labor force mobility. Yeah, in the time, I'll stop here and leave this slide. Thank you so much.
That top step almost got me. Thanks for the warning. I want to thank, I'm the last discussant of the last paper, so I take the opportunity to thank the organizers. It's been great. You've really done a terrific job to all of you. And I want to thank you for inviting me. I'm a newcomer to this area, and I've learned a lot both from the sessions, especially the mayor's panel was really interesting. I'm going to refer to it in my discussion and in reading the paper. Xiaodan is currently visiting UBC, where I'm from. I'm Ron Jamrino from the University of British Columbia. And so we've had a chance to discuss the paper several times. I've written a referee's report. I thought I could give a referee's report. And I'm not going to present that here. I think my talk, I decided, I think it might be most useful to try to give you a sort of a higher level picture of this. It's a very complicated, long paper. It's like 80 pages, I think. It took a lot to get through it. And it's ambitious, so it's a good paper. So I'm going to start with some very broad motivation. So this is really about the provision of public goods. So if we, there's this issue in economics that if David and I disagree on how many apples we want to consume, if we can trade through a price system, the price mechanism is going to adjust the supplies and demands and quantities so that we're happy. At the end of the day, I might want more, you might want less. The prices are going to make us do the right trade-offs. If we disagree on how many parks we want in a city, there's no immediate mechanism that's going to do that. So Paul Samuelson pointed this out way back when, and this is a quote from Thibault in the 50s, also way back when, that said, there's no market-type solution to determine the level of expenditures on public goods, how many parks we need. He's basically saying it's all a political thing. And so Thibault made a very important contribution to economics by saying, well, hang on, if David and I disagree on how many parks we want to have in a city, we'll pick different cities, we'll move. And And now we're not talking about we're going to move, like in the next month, but ultimately that's going to be a mechanism that will determine the level of public goods that are provided. So migration, that's the important point of this motivation. Migration is critical to the equilibrium and the allocation of public goods. So public goods are things that we don't have prices, we can't measure them. And that's something that cities are very important for. So mobility is critical to the allocation of resources that cities engage in. And so the fundamental question, the research landscape that this paper fits into is, well, so how does mobility affect debt financing? And we discussed case studies yesterday, and this paper has 3 case studies in it. And in fact, the fundamental sort of theoretical insights here come from another case study, one of them, which is Detroit. So this is a widely used one, but just to repeat, in the 2013 bankruptcy filings in Detroit, they pointed out that the population tax base fell by 26% from the year 2000. So this is the mobility, and part of it was the infrastructure had fallen. I'll get to that in a minute. Tax revenues were down 20% in 5 years. Tax rates were the highest in Michigan. Despite the fact that rates had been raised, the revenues were down. There were 78,000 vacant buildings at that time. The police were down 40%. Crime was 5 times the national average, and 40% of the streetlights did not work. I always am just blown away by that last statistic. It's like, what? You can't even get the streetlights to work. And it was really interesting. The mayor's panel yesterday, when they were talking about Milwaukee, I think I heard him say, we could have been Detroit. And I think that's very interesting. And they took corrective actions, okay? So the questions that come out of that is, did Detroit borrow too much? So this is from a sort of a corporate theorist point of view. It's like, well, how did they end up in this situation? Did they borrow too much before? When they built the Joe Louis Arena in 1979, I think it was, did they borrow too much? Should they have paid more for that with taxes initially? Does potential mobility explain how much they borrowed? Is mobility responsible for the deadweight financial distress costs? Like all these vacant buildings and things like that. And why were the costs not avoided prior to 2013? Why didn't they start renegotiating or taking corrective action prior to that? And how should Detroit respond once that's happened? So these are the kinds of questions that come out. And my question in reading the paper was, so where do you fit in all this? It's got an awful lot. It's a great data source, and there's a tremendous amount of complicated work in here. So my suggestion is this is a dynamic capital structure study. I think when we first met, I wasn't sure, and I'm glad you're now saying that's what you're doing. The main contribution is empirical, I think. The main question is how much should a city borrow, and how does that depend on population mobility? So that's the basic underlying question. And how do you respond afterwards is part of the answer to that question. Because if we're going to say how much should we borrow today, we have to think about what happens later if things don't go well. And I must say a topic that hasn't come up in this entire conference, I don't think, is bankruptcy law, which is pretty critical, even if you don't use it. It's pretty critical because it shapes the game that you're going to play eventually. Okay, so where does a dynamic capital structure approach fit into that? Well, we need a basic idea of how much should a municipality borrow. And we have that basic idea essentially from that Detroit example and the combination of Tebow and Detroit. If people come for the infrastructure and they leave because of the taxes, you'll get an optimal capital structure that basically smooths the amount of taxes you're going to charge over time. You want to avoid the situation which has been called a free rider, where you pay for the Joe Louis Arena in a certain period of time, then everybody gets to enjoy it for free. People leave when you got to pay for it; they come back when you have to do it. So, capital structure theory says, well, that's the theory, and then empirically we say, is that really what happens? So, the important challenge, these are early days in this literature, is this mobility really happening? Is that really driving the kinds of decisions that we see at the city? So without transaction costs, you get this target, and every time a municipality moved a little bit away, if the coal industry, which was showing signs of moving, and suddenly you're getting a reduction in your tax base, then you should immediately reduce your debt. And if you get a bit of growth, then you should do the other. So without transaction costs, you get this target. And in this graph, if you can't see it, it's time on the one dimension and then a measure of leverage on the other. So without transaction costs, we get this one target. With transaction costs, you get boundaries. You get an upper and a lower, and the idea here is transaction costs are going to keep you from getting to that target all the time. So in Xiaodan's and Paul's paper, they've got a lot of transaction costs, and that's because they're doing a dynamic fitting. Now, why is that important to do? So with transaction costs, the targets become boundaries. And now what we'd see is if you were to observe what a municipality's capital structure is over time, it will wander, such as that line that I hand drew. So I hope it kind of conveys the idea. But as the auto sector starts to leave, as the coal industry starts to leave, as you start to get changes in the economics of the municipality, you're not going to rebalance every day. You don't wake up and say, oh my God, we're not at the optimal, we better get right back to it. Instead, what this literature proposes there's boundaries. And when you hit a boundary, then you rebalance. And it was just delightful yesterday to hear the mayors talk about the boundaries and how they got around it, right? The Milwaukee one really stuck. It's like, so we got to this point, we're going to become Detroit. If we don't do something, we're going to have to go through a lot of political gymnastics to get a tax increase in, but we got to do it, right? So that would be one of these boundaries. And what happens, I can't point to it, maybe you can't see it, but if you drift upwards in the leverage so it's getting too high and you think you're going to be in financial distress, then you got to bounce right down. Okay. So the importance of dynamic rebalancing is in explaining actual capital structure behavior. The static model won't do it, and that's what this paper, I believe, can do. All right, so it's the most extensive data collection to date. The application to dynamic capital structure model of a municipality, it discovers that labor mobility is theoretically and empirically useful. It's an excellent first step. I urge a few improvements. So number 1, number 2, and number 3, please shorten and simplify. Right? This is a really long, complicated paper, and it really was hard for me to figure out that's what they're trying to do. And that's not I write the same thing. Your first draft is everything that my advisor told me. You cannot write down everything that you've discovered, right? And I forget that many, many years later. It's still the case. Clarify the motivation and purpose. I think it's a dynamic capital structure. Make that clear. I'm not going to go through. I've conveyed some of these, and I know I don't want to push my time limit too much. I guess I would say, why is labor mobility important? And I have one technical point that I want to emphasize. In the model, as she said, there's this cash flow, this bailout that comes from the taxpayer to the city when they're in trouble, and that's part of their policy prescriptions. But here's the technical issue. It doesn't show up in the labor mobility equation. So it's a freebie. You can raise taxes by calling it an emergency fund, and it won't cause the population to leave. And that's where the prescription for Detroit in the paper comes from, which is, what they should have done is had this emergency call for money. Well, they've already lost 26% of the population. The tax base is declining. If you try to get any more money out of it, call it what you want, it's going to come out. So I think technically I'd like to see that corrected. I mean, I just don't see how that makes sense, just because you call it something different, that it's not going to show up in the empirical. And I think the measures, I've talked to her about the measures of leverage and taxation. So it's an important topic. It's early days. So I really applaud it. I've said to Xiaodan many times, I hope to publish this paper. We need to start getting more papers like this out there. Main suggestion, clarify, simplify, develop measures. And I look forward to future versions and ultimate publication.
Great, thank you. So why don't we just give you a chance to respond if you'd like.
Thank you so much. And Paul and I really appreciate Ron's thoughtful and very constructive comments. Yeah, exactly. So before I came here, we talked quite a lot at UBC. So let me respond maybe one key point, which is reverse transfer payment. In other words, in the model, we allow the municipality to declare emergency so they can collect some funds from the local residents. And indeed, in our Detroit simulation results, I didn't show because of time constraint. So we do find that we recommend Detroit, they should increase the expenditure and lower leverage, cut the tax rates. But where the money comes from, you need to spend. But you have a lower tax revenue and debt financing. So our model the other way to get money is to declare emergency. But this is one way to proxy other sources of funds. It could be like in reality, the money can come from, say, the state government, some transfer from there, or the federal government, etc. So that's what we try to, proxy. So you need, when you face some financial distress, you are supposed to intervene earlier. So create space for your tax rates and leverage and get money somewhere else. But you need to figure out a way, like Janesville case, they figure out they can reevaluate the property. So by higher assess the property values and higher tax rate, higher tax revenue, but lower tax rates. So that's pretty much we want to respond. And but second point is the features. Reverse transfer payment is not the key to generate our story. So we can completely shut down that channel. This is only important for our simulation studies. So when I show the first condition for the optimum tax revenue, you don't see the E somewhere. So our story does not depend on the negative E, the reverse transfer payments at all. And also another point, I think Ron put on the slide, but he didn't mention. So we do think the risky bond and bankruptcy law is a very interesting area to explore for future. So first, I think Ron has already have some, his paper also have like municipalities capital structure, has some discussion on that. So how the bankruptcy law to affect the, for example, the leverage decisions. We think this is an interesting area to explore. And also, meanwhile, Paul, my co-author of this project, he also has a empirical paper on that. So to study, like, explore the state-level bankruptcy law heterogeneity to explain the muni bond yields. So we might be able to contribute in future by set up a structural model to see the model very carefully about those different bankruptcy laws at state level, then see how it influence the municipalities' financing choices, etc. Yeah, thank you.
Great. Okay, so if people want to start raising hands, I'll start with a question. So I was thinking, as you were talking, how I can kind of marry the two papers from this session. So I wondered, how would unauthorized immigration factor into your model? Would it change the tax elasticity? Would it change labor mobility? Do you think it would play any role at all?
I think it's a very interesting point and also important. I do thought about it before when I prepared the slide and presentation, because I realized there is a paper about unauthorized immigration. So I think also similar to the presenters, this is if it's long term, what I feel is unauthorized immigration, they will contribute to the local agri demand, right? Then create some jobs, create job opportunities. So we push up agri demand, push up the production, then the local factory might need to hire more labor, create some job space. So I would think in the long run, it will benefit the municipality.
Can I add just one point to that? So in the previous paper, there was this discussion of if you have communities that have a lot of a lot of people from the same country as the immigrants, that has an effect. In terms of this model, the reduced form that both you use and we use of people migrating has behind it some kind of a structural model where everyone takes a look and says, if I leave, I'm going to get a certain level of income somewhere else and a certain level of infrastructure, but there's a cost to leaving, and that cost to leaving is the personal cost of the family and friends that you have. That's a big component of it. So I think that's a natural area where these two papers would collect, that this cost is going to be affected by the makeup of the community.
So why don't we start with Dan?
This is Dan Garrett from Morton. Xiaodan, thanks for sharing this really interesting paper. I think it's really cool. I think one of the things that jumped out when I was reading your paper is that the tax elasticities are all quite similar. And I think when we think about kind of what drives labor mobility and mobility in general, there's of course a big urban economics discussion of that. And some of the cities you're looking at for, say, in the LA area all realistically are sharing one labor market. And so if they change their taxes, people might change kind of where they live, where they buy houses, but the job market is all kind of the same. So I was wondering if you could talk just a little bit about, if we zoom out and think about commuting zones all actually sharing a lot of amenities and actually sharing particularly the labor market, how that might interact with what's driving the fundamental elasticities that you're measuring.
Yeah, I think this is a good question. So we actually didn't look into the determinants of low tax elasticity of mobility. So for our current version, we just say this mobility level is kind of industry dependent, sector dependent. But currently we are working on something else, I think similar to what you mentioned. So we were trying to say maybe your social capital, like your network in that location may affect your mobility degree. So we were thinking of that to try to see if there is large heterogeneity and to see how it impacts the municipalities' choices. Did I answer your question? Thank you.
Okay, that's Dan again.
When I think of the Detroit bankruptcy, one thing that I think about is the fact that Detroit paid its workers for a long time with defined benefit pension plans. And so part of what they were doing was they had a retiree base for a city of 2 million people that they were continuing to have to pay based on these, based not on infrastructure, based on basically offering them wages that were like paying them in a way that made them creditors. And I wonder if, like going forward, I think outside of cops and firemen, like defined benefit pension plans are kind of a thing of the past. And if that will retard to some degree or slow down to some degree some of the, in Detroit it really was kind of a race to the bottom. Like if you're the person who sticks around, your taxes will go up to pay all these retired cops who are in Florida. And I wonder if going forward as the wage packages shift towards wages, that will slow down some of the really extreme race to the bottom municipal finance catastrophes.
I think this is a very important question, and to be honest, we haven't thought about that because in our model it's more complicated if you include, as you mentioned, those pension obligations. But we think this is a very important area to look at because when we read those financial statements, when I look at the data at the municipality level, indeed, after 2015, they started closing like their pension obligations. We found that the obligation level, like liability level, jump by like 20% or 30%. So it's a huge issue there. But for now, to be honest, I don't know how to answer your question, but we will think about that. Thank you.
Can I throw in a quick response? Because I've been thinking about this issue quite a lot. I think, so in the municipal corporate finance area, we have relatively little theory. In the corporate finance area, we have quite a bit of theory, and you know, a lot of these, so there's principal agent problems, and I think what's really coming out when you think about the pensions is there's a difference between funding public goods that are not long-lived. So you hire a policeman for tonight, you got to hire him again tomorrow to do the job. And if you pay him with a deferred payment, it's different than building the Joe Louis Arena and promising to pay that back later. Our Prime Minister, I'm from Canada, our Prime Minister got in a lot of trouble by suggesting, I guess they didn't like the answer. That's what you get. Mark, I wasn't going to say anything bad. For suggesting that the accounting at the federal level should actually differentiate capital from regular operating expenses. If I get cut off again, I am quitting at that point, and I'm going to check my passport, I think. So I think that's what we need to do, theoretically, at least in this literature, is to take a look at, so we've got both of those things going on in your paper. We've got services. In ours, it's pure infrastructure. Those are two very different problems, and deferring payments for services makes sense only if you're going to income smooth. And so we're deferred now, but you're going to pay back next period, as opposed to deferring for capital, which can go for a long time.
Perfect. All right. Perfect timing. We're going to have to take the rest of the questions offline. So thank you so much to Xiaodan.
Can we get the panelists up for the next session? We're going to go right into that. And I will show you where to sit.
Okay.
Can you hear me?
Yes. Okay, great. All right, well, thank you, everybody, for sticking around. I think this is going to be an interesting panel. I'm certainly very excited to hear about what our folks say. So we're talking about the effect of the Trump presidency and recent congressional actions on the state and local sector. And I'm not going to waste time reading the extensive bios of everybody on this panel, but let me just say that there is a wealth of experience for every single person coming here. So Dan Hartman is Managing Director and President of PFM Financial Advisors, and he's been doing municipal finance for 30 years. Kristen Young, who's a visiting fellow at Brookings, has been in and out of the Obama administration, the Biden administration, North Carolina, really understands healthcare and state and local and federal level healthcare. Tracy has been doing state and local and tax for many, many years. And Mark Becker has his career in higher education that also spans, again, more than 35 years. So in first line of the bios is like everybody, 30 years, 35 years in this. So we have a ton of experience. So, and there's a ton of topics to cover because when we think about the Trump administration and Congress, like almost every part of the U.S. economy has been affected. So we're going to go through them and see what's going on. So let me start with you, Mark, because you said you had a good way of give an overview of where state and local governments are, where the municipal finance is, given everything that's happened politically in the past year or two. Oh, I'm sorry. Dan, I meant Dan. I'm looking at you.
Sure, happy to start here, and thanks for being here. So at PFM, we're municipal advisors to state and local governments, 2,000 of them across, so I'm really kind of in the trenches of working with clients as they work through some of these issues. And so I have a little bit broader perspective, less sector specific, but I think there's certainly a narrative that there is that the sky is falling. Perhaps it's the Trump kind of breaking of norms or bombastic nature. There's certainly, we think, very sizable changes happening here, but perhaps not as large as others think or that. I guess we see two key transitions going on. One of which is clearly a push from funding at a national, federal level to the state and local governments. You see that from ever as small as FEMA on disaster to NIH and research funding to Medicaid, which is the obvious one, but as well as clean energy, and certainly in transit as well. So across the board, pushing it down from from federal to state and local. And the second one is really an outreach, I think, of kind of an isolationist approach, whether it's tariffs, immigration, Buy American, or content provisions within some of the federal programs. All of those things that I would put under kind of an isolationist are having significant impacts. The second thing I'd point out, I guess, is that for us, the trend, that there is going to be a significant impact, but that transition is not immediate. The Medicaid cuts really don't kick in until later in 26 or beyond. The clean energy subsidies continue on through 27, even on wind and solar. And so a lot of these impacts, I think, are going to be felt not immediately. There are certainly acute ones that I'm sure the panelists will address in certain sectors, but we think it's going to take a few years to really see the ripple effect overall. And then the last thing I would just say is from a market perspective, where we are in the capital markets every day, there has not been much of a difference. No problem accessing the capital markets. There are very little premiums that we see for the market putting, if you want to raise money for any of these, even the affected sectors have very, very modest premiums, if any. So we don't see that even in the higher ed group or beyond. So the market impact, I think, has been minimal. The rating actions have been minimal, and it's really more wait and see. We do think some of those impacts are coming, but at this point really haven't been felt.
That's really interesting. Why don't we start with, we'll just go down this way. So why don't we start with healthcare, Medicaid, also ACA. Kristen, how do you think the state and local governments are going to be affected? Which governments?
Absolutely. So I would put the effects that are coming in the healthcare sector to state and local governments into two buckets. One around changes of financing in the Medicaid program itself that are going to take some time to play out, but will put new pressure on state financing arrangement. And the second, in the way that the increase in the number of uninsured Americans is going to affect programs other than Medicaid, because people who used to be receiving care financed through Medicaid or the Affordable Care Act with largely or entirely federal dollars will instead be uninsured, and their healthcare needs will be paid for by a variety of state and local safety net type programs. So maybe we can start on the increase in the uninsured. The Congressional Budget Office has estimated that 10 million people are going to become uninsured because of the changes to healthcare financing in the recently passed legislation. That's on top of about 5 million people who will begin losing health coverage in 2026 because of changes to the Affordable Care Act subsidy structure. This is effectively erasing about 2/3 of the gains in health insurance coverage that we have seen since the Affordable Care Act, and erasing almost the entirety of the increase in health insurance coverage that we achieved during the Biden administration. So these are very big shifts that will leave a lot more people without health insurance. And again, those effects will begin in 2026 and phase in over time. And so that is going to put pressure on a variety of state and local safety net programs that pay for health care for uninsured people. That will include certainly jails and prisons, which finance a huge share of mental health care in this country already, and will face a bigger burden as 15 million people lose health insurance and access to a regular source of care. I expect big strains on state and local systems that finance mental health services for the indigent population. Those services are funded today with a combination of Medicaid dollars, federal block grant dollars, and state and local resources. Since the Medicaid expansion took effect in 2014, the share of mental health services that were financed by Medicaid grew dramatically in expansion states, and we are looking at a significant reversal of the federal dollars flowing into the mental health services safety net. And so challenges for state and local programs that finance both inpatient and outpatient mental health services, as well as substance use disorder clinics and other kinds of programs like that, as well as public hospitals, which are financed in a variety of ways across the country, but obviously a major community expense, local expense in most big cities across the country. As for the changes within the Medicaid program itself, and I can be brief, states are losing a lot of flexibility, and flexibility is perhaps too neutral a word. There were abusive arrangements that were taking place in some states, and those abusive arrangements are being shut down. But with the loss of the ability to engage in some financing abuses, states are also losing a fair amount of flexibility that had been real, meaningful flexibility in the way they finance their Medicaid program. Those changes phase in fairly slowly, and they primarily only affect expansion states. And so one would expect sort of increased pressure on the way states finance their Medicaid program over time, though a longer tail on some of those changes than the increases in the uninsured. So maybe I will stop there, and we can get into more of it as we go.
Can I ask you two things, really? Can you comment a little bit? So you said something about the expansion states are going to be hit. When I think about the Medicaid cuts, though, it's not necessarily focused on the expansion states only. We worry about rural hospitals. And so thinking about sort of the cross-state variation, is there some states we should be more worried about rather than others, or?
Yeah, I think the states I would be most worried about, and Tracy, I'm sure you have a perspective on this as well, are expansion states with large immigrant populations, because there are major hits to immigrant eligibility for Medicaid. Whole sectors of people who entered the country lawfully, but through a variety of visa statuses other than green card holders, are now losing their eligibility for Medicaid and Affordable Care health insurance completely. And so that is a big hit. This is a large chunk of the population in some states and cities, and so those are the states that I would be most worried about. The other state variable that is a little bit harder to see from the surface, but all the data is there, has to do with how states finance their payments to hospitals inside the Medicaid program. So states can sort of broadly pay for hospital care in Medicaid in one of two ways. One way, and the way that seems most obvious, would be a person gets a hospital service, and the state pays them roughly what it costs the hospital to deliver the service, and those dollars are moving in kind of a normal way. And some states do finance most hospital services that way. Other states take that same person receiving a hospital service, and they pay the hospital about half to 70% of the cost of the hospital service as a payment for receipt of the service. And then they slosh a whole bunch of extra money around to their hospitals through a variety of financing mechanisms. And states that have greater reliance on the money sloshing around and less reliance today on the straightforward fee-for-service payments for hospital care are going to be hit harder by the pressure on the financing arrangements. And the states that are the most aggressive in using the slashing money don't cut cleanly on partisan lines. So Texas is a state that has made significant use of some of these financing mechanisms over time, and you see it in sort of pockets all over the country. And so there'll be differences along that dimension as well.
And the other question, I'm going to ask Tracy this, which is, so you're talking about so the federal funding is being cut for states, and so then states have decisions to make. What do they do about it? How much do they say, well, we don't want the uninsured rate to go up so much, so then we're going to expand how much we spend on health services in general versus we're just going to let the people bear it. Do you have a sense, Tracy, on how states are thinking about it right now?
Yeah, I feel like at this conference we often start by saying, well, states just passed their budgets. States with a July 1st fiscal year just passed their budgets. And if we were to look at those, we could say it's pretty much smooth sailing. Revenues are sluggish, but not horrible. Their rainy day funds are very healthy still. They're using them to make one-time expenditures, which people tend to think is kind of a good idea. But then there is sort of this thing around the corner. And I appreciate the framework that you laid out, since I have been searching for one to sort of organize my thoughts on all of this. But I would question the relative mix of devolution versus isolationism. If this were traditional devolution, there would be things like block grants. In K-12 education, instead, you see a $7 billion funding freeze, some of which has been undone, but in keeping with the priorities outlined in the president's fiscal year 26 budget, pushing back on perceived uses of federal funds for things like, English learner stuff and teacher training that is geared toward being sensitive toward immigrant populations. And there's some dispute about the legality of all of this. He's being sued by attorneys general and I think a couple governors in about half of states, all Democratic states. So very quickly this starts to sound, partisan, and I wonder how much policy oomph there is behind it when simultaneously they've disbanded the part of the Department of Education that monitors progress in the states with experimentation and doing things differently. So if this were really about devolution, there would be actual experimentation that we could measure and monitor the success of. I think same thing with healthcare. There are very pointed policies toward expansion versus non-expansion states. So I think I wish it were as simple as devolution, because then there would be a very rich research agenda for all of us to go and look at. But it's a lot more chaotic, which, getting back to your question, makes it a lot harder for the states to know how to respond. And the delayed implementation is another aspect. Is this real? Is this really going to happen? I think with the work requirements, now I'm not remembering if it was Medicaid or SNAP, but there's a possible exemption if you're making a good faith effort.
From 27 to 29 for Medicaid, yeah.
What does that mean? How do you demonstrate that? A lot of uncertainty.
And states typically hate uncertainty, but is it, we think of states as very, very risk averse. Do you think they are going to start curtailing spending, raising taxes, or what do you think they're going to be doing before that uncertainty unfolds?
Right. So if some of the harsher Medicaid stuff goes into effect in 2027, they need to start thinking about what to do next year because of the way fiscal years work. My colleague Lucy Diane has a blog that's coming out soon about just trying to do a roundup of all the states that are talking about taking action. But I think for the most part, it's a lot of talk. Like, we might need a special session. This looks really bad. New York has, its fund that would basically be zeroed out, and so they have something like a $3 billion loss that they need to to figure out how to address. So yeah, I think they're still sorting out like what are going to be the impacts and when do they need to start getting on this.
Before I go to you, I want to go back to Dan, because you said there's no market impact, basically state and local. It's all sort of like, we'll see, which is kind of surprising. Like, why wouldn't the markets at least say, this is going to be bad? Is it because we don't know if it's actually going to go into effect, or because it's just, if we don't know how to analyze it, we ignore it, or?
Yeah, and perhaps it's that some of this the borrowing is not a leading indicator but a lagging indicator, and you look at ratings from the rating agencies as one. So you look at the states. I looked at it last night. So there's not one state rated by Fitch with a negative outlook right now. Not one. There's 15 with a positive outlook. There's 18 with the AAA rating. I'm not sure of 18, but high teens with the AAA rating that are now rated higher than the federal government. So it does not suggest that the sky is falling from Fitch's perspective. I think there's a lot of challenges out there, but I do think ratings, and if you were to look at the borrowing costs of these AAA states, where they have priced relative to the benchmark indices, right there. There's just not a statistical difference in any of that at this point, which is remarkable.
Yeah. All right, let's move on to higher ed. Thinking about everything that's been happening that might be affecting higher ed, including the assault on education institutions, research grants, immigration, like so many things kind of through that lens of higher ed.
So the sky is falling. Everything I've heard so far is dislocating for me. So the states may be in great shape, but they're cutting their higher education budget. The state of California, with a governor that's going to run for president, is slashing their higher ed budget. The governor of the state of Maryland is also cutting their higher education budget. He's probably also going to run for president. So don't expect it to get a lot better if under a blue administration than a red administration if you're in higher ed. I'd say also that we've heard that many of these effects are lagged, but for higher ed, many of them are immediate, starting with executive orders on January 20th and January 21st, which have basically led to cancellation of grants, primarily because they do not align with administration priorities. Much of this has to do with their interpretation of the Students for Fair Admission lawsuit, which basically the Supreme Court ruled that you cannot use race as a factor in admissions. The administration has interpreted that you can't use race as a factor for a lot of things in higher ed, including scholarships and other things, and grants. And so that has been an immediate and first order effect of the cancellation of grants. Also, starting with Super Bowl weekend, we had a series of 4 different agencies announce that they would change the partnership with higher education for funding the research infrastructure. So not the research per se, but the infrastructure, which we call F&A, or Facilities Administrative Costs, which has since the 1940s, 1950s been on a negotiated basis between the institutions and the federal government. By fiat, by orders from the agency heads, would be immediately cut to 15%. Interestingly, it doesn't say 15% of what, because negotiated rates are based on what are allowable costs, not total cost. But all that is playing out in the courts. So that is not immediate yet. It is playing out in the courts. And there is a process underway. 10 associations here in Washington, including the one I used to head, have worked together to come up with an alternative model, and are now working with Congress and OMB to try to get to an alternative model so that those damages are not so dramatic. The other piece then, which I don't think has been mentioned here explicitly, is the One Big Beautiful Bill Act. Also has a lot of implications for higher ed, most of which take effect July 2026. But the Pell program, which provides access for low-income students, has been changed significantly, some ways positive, some ways negative. On the negative side, eligibility requirements have been tightened, which in a sense I've been waiting for since 2009, when they were loosened by the Obama administration in the fiscal crisis. So that they're going back to tighter conditions there. The big change, which sort of came in at the 11th hour of the One Big Beautiful Bill Act, thanks to one member of the Senate Help Committee, is the Pell program, which has been basically an entitlement to low-income students, is now a last dollar financial assistance program rather than a first dollar financial assistance program. And it's way too early to know what impact that's going to have.
What does that mean?
It means you can't get the Pell Grant until you've exhausted all other available sources of financial aid for that student. instead of you automatically get that grant and then you can layer on other forms of financial aid. So the financial aid offices of these institutions have basically been turned upside down. And it also turns upside down particularly many of the large state universities or states that also have their own programs for low-income students. Because if this is a last dollar program, then those institutions or states have to rethink how they're doing theirs. So for example, in Minnesota, I believe it's in statute. It's not a University of Minnesota thing, it's a state of Minnesota. So there's going to be a lot of moving around in the financial aid space just around that. On the workforce side, after many years of debate in Washington, Congress did pass and include in the One Big Beautiful Bill Act what's called Workforce Pell, which is for the first time is to allow federal Pell grants to go to low-income students for short-term workforce programs. These programs are limited in the number of hours and the hours of instruction and the number of days down into the weeks. So that the impact of that remains to be seen, but this is an expansion of federal aid to a different type of program than historically. And then lastly, just on the Pell side, there has been a Pell shortfall, which means there's not been enough money in the federal budget to pay for all the Pell obligations seen now and coming in the immediate future. Those were funded in this bill. So that they've decided to do that in one fell swoop rather than take it up in the 26 or later budgets. In addition, in the student loan program space, the One Big Beautiful Bill Act took out that the federal government paying for the debt or for the interest accruing to the students while enrolled. In other words, they will begin accruing interest that they on top of what they owe immediately instead of at graduation or separation. The big hit for institutions of higher education is in the graduate space. This has been a target of the Congress for a while because there is academic research that shows that as long as the Grad Plus loans programs were in place, which covered up to the full cost of attendance, that there was basically no governor on graduate education tuition, and that with more financial aid, you've seen more tuition increases. So even though states have held down their undergraduate tuition, or state institutions have held down their undergraduate tuition, on the graduate side, it's been going up and up. Well, the instrument for that is gone. Grad Plus will go away next year. In addition, the limits for graduate student loans are being tightened or being set lower. So those are the first order effects. The second order effects are on the Medicaid and immigration side. The Medicaid issue, we'll see the impacts on hospitals. This takes me back to the 1990s because I have been doing this for over 30 years. In the 1990s, we saw academic health centers or at universities selling their hospitals in some cases. A couple of the notable ones at that time were Tulane, the University of Minnesota. Other institutions were hotly debated, like at the University of Michigan. We'll see if there's enough stress. That remains to be seen whether there's going to be enough stress in these hospital systems and academic health centers to have an impact as whether it be back. And then the big one is whether the Medicaid cuts are going to basically put pressure on state budgets. That will then mean less money for higher education. The only states right now that have been actively increasing funding for public higher education have been Florida and Texas because they're flush with money.
What about the impact of immigration on students coming here, international students, big source of strength for the U.S.? Do we see what's happening yet in terms of who's coming for the next semester, this fall semester, or?
Well, it's certainly early yet, but everybody expects there's going to be fewer, particularly graduate students coming, as well as full-paying undergraduates, meaning there's many institutions in this country that have basically been able to keep their in-state tuitions low by basically increasing enrollments of full-paying students, particularly from China. That is definitely changing. The entire enrollment structure is going to be changing at the same time that we have a demographic cliff, meaning the number of students graduating from high school to go to universities is also changing. Now, in the immediate term, in terms of stress, there's a trickle-down effect. The big institutions with strong brands, they will make their enrollment targets. They may make their enrollment targets with a different mix of students than they've had historically, and there will be a hit on the international students, but this will trickle down and be felt in the more regional institutions in the state. And we're already seeing this, for example, in the state of Ohio. I would put good money. Ohio State will figure out how to navigate this. They've got the resources, they've got the brand. But when you get downstream at Miami of Ohio, Ohio University, Bowling Green, Kent State, and so on and so on, you're already seeing incredible financial stress in those institutions.
Yeah, I would, and certainly, Mark, empathy for your sector, which is definitely harder hit, and I think we see that in our higher ed clients. And I think of any sector out there, there have been more proactive measures. We definitely see many that have already imposed budget cuts, that have laid off workers. I mean, whether that's Stanford, Johns Hopkins here, others around the country, particularly those hit by some of the NIH and other research funding. A lot of them that have borrowed more money. So Harvard, MIT went out and proactively have borrowed just on a taxable basis to have liquidity to get through this range. So we definitely see more activity out in the field as well, and I think this sector has been certainly hard hit, or the first to be hard hit.
Yeah, we expect. My prediction. I've been making this since the winter, and I think that we're seeing it now. Is every single institution of higher education will be going through budget cuts, which will include some round of layoffs. The question I've been asking is, how will it compare to what we saw after the financial crisis? Because in the financial crisis, particularly for state-funded or state-supported institutions, none are state-funded, some are state-supported, they had massive cuts in state funding, generally made up those cuts either through increases in tuition or fees and enrollments. And so we've got the pressure of fewer international students already staring us in the face. And I think one of the big questions is going to be, particularly for the big state institutions, is just how far can they go with tuition increases? Because since the financial crisis, the rate of tuition has not gone up at the same rate as inflation. So the real cost of attending college, once you adjust for inflation, has been going down. I think we're hitting a point that's going to take us back to 2009, where we'll probably start seeing an uptick. However, with the issues on the student debt side of the equation and with the further strictures on student loans and Pell programs, that's going to be really ugly.
And when you say it's going to be really ugly and you think about what's happening now, do you think of it as something that's kind of like a 2009 temporary thing, or do we think about this as having kind of long-run structural effects? And how do you, what would affect whether or not it's sort of something that we can recover or something that's kind of going to really have a very long-run effect?
I'll just put it in the words. So we had our presidents in town in June for our annual presidents meeting, and president from a blue state, and in a major city, basically said, we've got to change for the future. Nobody that I know of realistically expects you're putting the genie back in the bottle. The entire relationship between the federal government and higher education has been changed. There's still a lot to be worked out. I would say in terms of the de-evolution thinking is, it's not that you can't do experiments. The experiment is if you blow it up and rebuild it, what impact does that have? Because that is the thinking behind this. The thinking behind this is Silicon Valley, which is you run fast, you blow it up, and then you put it back together. And that's what you see happening in the U.S. Department of Education right now. Is they're bringing people back, they're figuring out what they have to operate, and they're happy to be rid of what they got rid of that they don't need to operate.
I think that, I think the Silicon Valley analogy is really apt, because as someone who's been thinking about economic development for a long time, it used to be sort of a joke that the best strategy was to have a land-grant university 30 years ago or more. Eds and meds were always the things, right, that juiced local economies. And so if we're breaking those things, then what is the strategy?
Can I ask a little bit? Sometimes when we think about what's happening to education, we think about Harvard and Columbia and sort of very blue state, very woke. Is that something? Is the damage going to be focused on them, or is it really much broader?
No, the damage is shared everywhere. The Harvard, Columbia, Yale, Penn, et cetera, get covered by the New York Times because that's where the reporters went to college. It's not that complicated, and that's what sells papers. But the damage is across the sector. Meaning, when you look at grant cancellations, that happened in Montana as well as it happened in Cambridge, Massachusetts. So the effects are widespread. But I think some of the personal pain is much deeper at those institutions that are targeted. But we've seen that play out not far from here lately. The University of Virginia's president resigned under some pressures about whether or not they had gone far enough in following the administration's DEI executive orders. We're now seeing that play out at George Mason University, which is but 3-4 subway stops or metro stops from here.
So Mark brought up the big, beautiful bill. I wanted to ask you about that, Tracy. Sort of what the implications are, the SALT, what else is in there that state and local governments are now thinking about?
So the bill basically extended the expiring individual and estate tax provisions of the 2017 Tax Cuts and Jobs Act. It added some new things in there that were priorities of the Trump campaign in 2024, which were no tax on tips, no tax on overtime, no tax on auto interest loans, and a new bonus deduction for seniors. So unlike some ways it's been characterized, it is not no tax on Social Security. That would be a very different policy. The bill also prevented some changes to the business tax breaks that were sort of phasing out under the 2017 law from happening. So that would be 100% bonus depreciation or full expensing of qualified investments, a less restrictive cap on the net interest deduction, and allowing companies to expense research and experimentation expenses rather than amortizing them over 5 years, which was a pay for in the original 2017 legislation. So much like in 2018, states now have a choice of whether they want to sign on to these changes or not. So about half of states have something called rolling conformity, where it just sort of happens. Others have static conformity set to a specific date, and so they have to take action. And of the states that are having to figure out if they want to take action, it's just a question of whether it redounds positively or negatively to their bottom line. So those individual provisions, the ones that are campaign priorities, which are temporary, are not super well targeted. They're not super expensive, but they're also not super well targeted. And so once it's out there, I think it's hard for them not to sign on to something like no tax on tips. It's interesting to me that the big criticism of that proposal from the Democratic side is it just doesn't go far enough in the income distribution or in the categorization of commonly defined industries. On the business side, you saw under TCJA that a lot of states did not want to conform and give away their tax base, and so I think there'll be the same kinds of things going on. And then one of the changes actually is replacing something from the 2017 law, the GILTI, which is supposed to be something that would prevent profit shifting overseas, with NICTI or necktie. No one can figure out what to call it. And that is something that really is not designed for the state and local sector, which doesn't typically tax foreign income. So there's a lot of people just kind of scratching their heads and trying to figure out what to do with all these individual provisions. But I think you asked specifically about SALT.
Well, that was the first thing I thought about. I hadn't thought about all these other things, how it affects what states have to do.
So
Yeah.
the 2017 law had a $10,000 cap. So there was talk leading up to the 2017 law of getting rid of the state and local deduction altogether. A lot of people in my industry love to critique it and say that it's just a subsidy for rich people and it's not right, we should get rid of it. And I used to be a card-carrying apologist for the state and local tax deduction because I would say, no, all those rich people actually live in places. And the places where they live actually have people who are not rich, who need services. And the federal government is engaged in a quid pro quo with state and local governments to provide service, to have the states and localities provide services that they are better able to provide because they know their populations, they know their costs, they know their geography. And so it makes sense that the federal government should subsidize states, make it easier for them to raise taxes to provide those services so efficiently. So they did not get rid of the deduction, but they capped it at $10,000. And there have been changes to the deduction over the years, and this was one of them. And in fact, those changes do not show the best support for the claim that I was making, that states respond by increasing or decreasing their taxes. So that was one chink in the armor. But what really did it for me was when there was talk of raising the cap, and as actually happened, they wanted it to be retroactive. So there's no story in which a retroactive tax cuts for high-income people is actually something that's going to incentivize states to have the optimal tax structure to provide the social safety net for the federal government. So I'm now, with all my friends on the side of perhaps this wasn't the best deduction. So they raised the $10,000 cap that was set to expire to $40,000, and this was a huge priority for Republicans in small House districts in high tax, high income states. And they were, as you all probably were following, they were just completely dug in. There was no way this legislation was going to happen without increasing the cap. So it's now $40,000, starting to phase out at $500,000, and it's temporary. So we'll be having this fight again in a couple of years.
Dan, you mentioned FEMA cuts. We had a lot of papers yesterday on the costs of climate change, and how are state and local governments thinking about those FEMA cuts and what's happening coming forward for them?
Yeah, I mean, I have more anecdotal evidence perhaps than kind of a structure here. We're certainly hearing difficulty getting payments. I think what the federal government wants to do is make it more disaster recovery as opposed to some of the resilience projects. So the funding for those front-end resilience is going away. I think at this point, it's that shift is not being met. I mean, I don't see that there is an increase to try to fill that void, and so it'll be interesting to see what the response is if we have a difficult hurricane season or flooding. Obviously, we've seen some of that in Texas, where the state legislature in Texas is spending a lot of time on flood. So I think it'll be driven by those types of structures.
So we have talked a lot about different issues, and we keep talking about states and states and states. But what is this because? How do local governments think about this? If they're not directly affected, but they do get a lot of money from the states, are they worried yet? Do they just really lag and just look at what they've gotten? Tracy, do you have a sense of that?
Yeah, I think that they are I think there was a question yesterday from my colleague at the Urban Institute to the mayors, like, how are you thinking about this? And I think they really do have their finger on exactly what funding might be affected, what has already been affected by freezes, some of which have been undone, and a question of, can we show the benefit of this spending? Can we try to I love the braiding and blending for all of us who have been in this for a while. That's a phrase that comes up a lot. Are there creative uses of streams of funds that would allow us to keep doing the things that we're doing without running afoul of the rules? So I think they're worried about funding freezes more than necessarily the Reconciliation Act. And some of the immigration enforcement stuff is going to affect their local economies. Immigrants are a big deal in the housing sector, in the hospitality industry, in the long-term care industry. I thought, it's a 1,000-page bill. There's a lot of stuff in there. I'm not a healthcare person, although I once was, and I worked in the long-term care industry. So one thing that I was interested to see was that there were new staffing ratios that were supposed to go into effect that are not going to go into effect as a result of this bill. But who provides the labor in a skilled nursing facility if not immigrants? So I just really wonder, how people are going to get the services that they expect from the public sector, from the private sector.
I would also add, from the perspective of local safety net healthcare providers, public hospitals, substance use disorder clinics, which are often locally funded, and other STD clinics, other kinds of entities run by the local health department or other instruments of the local government, there is a huge revenue change coming out of the recently passed legislation as people become uninsured, and so Medicaid or Affordable Care Act health insurance are plowing fewer dollars into those programs, and so you are seeing major revenue losses. There are also revenue changes on the grant side of things that have started, but I don't think we are done yet, as we see cuts in CDC funding and SAMHSA and HRSA funding, other sources of federal grant funding to states and sometimes directly to providers that trickles down to local governments. We are seeing cuts there that again have started, but I think are not done, and so there's a fair amount of unpredictability in the loss of grant funding there, as well as the impact of challenges in state financing and how that may flow through to local governments. Across the country, only a handful of states require county contributions to the financing of the Medicaid program. So California and a few other places where counties are also going to be implicated by the funding changes that are happening inside of Medicaid and needing to come up with additional dollars in certain ways. But these revenue hits are going to affect every county in the country.
Yeah, I think I want to certainly come back to the, where it's pushing from state down to local. But I think the backdrop for states and then, for locals as well is we've had a pretty robust economy. And, maybe in the last couple of years it's been flat. California is seeing a deficit just from the way their tax code set up, but generally it's been pretty good. And how long will that last? And I think if we see a downturn, it's going to be particularly acute as to the magnitude of the issue. So far, I think we've been fortunate that the macro environment has been pretty robust. I think one area that's kind of interesting that's been crowded out by some of these other issues is transit, for example. There is a cliff in transit this year where the COVID era money has run out. And so, yes, I think New York has tried to address that with congestion pricing, but there are other places at SEPTA in Pennsylvania or the CTA in Chicago or BART that have really significant challenges of where that's coming from. And the feds have told them there's not going to be another funding. They go to the states and say, well, we now have Medicaid and other issues, and where that funding is going to come from, I think it's going to be difficult, which could mean significant service reductions.
So I asked Mark about sort of the long run effects of the cuts to the education sector. I kind of want to do that throughout. Like for Kristen, how much? So you're like we're reversing 2/3 of the drop of insurance from the ACA. Can we get that back?
Yeah. So I have two competing thoughts on this question. To start, maybe on the optimistic side, in the course of the Biden administration, we drove the uninsured rate to the lowest level ever recorded. We had achieved very, very high rates of take-up among eligible populations. We had made coverage fundamentally affordable, and we had built a coverage system that worked. And there is a part of me that remains optimistic that it has been done. It has laid a marker down and made it possible to get back. And in support of that argument, the changes in the OBBA and other changes by this administration are fairly straightforward to reverse. It's money and eligibility, like coming in and out. They are dials that one can imagine changing. And so maybe there is some cause for optimism that we could get things back on the coverage side. On the other hand, what we have seen happen is a whole bunch of things that seemed politically impossible to do before have been done. And so that makes me very worried about the long-term durability of anything that anyone tries to get done in healthcare. Are we looking at a reality where healthcare policy, financing, coverage is ping-ponging back and forth every 4 years for decades, and what does that do to the healthcare system? And so I am very worried on that front. And then to say the thing that everybody says at every table that's talking about American policy right now, like nobody thinks the American healthcare system works particularly well. And so there are opportunities in the rebuilding to think about doing things better than they had been done before. And so there are potential changes we can imagine making that would strengthen the system over time. But it is hard to see how you do that if we are looking at this massive ping-ponging back and forth over time.
That is a good segue for the question about for the state and local sector in general. The Jennifer Palka at Niskanen wrote something yesterday in the Post about how, again, it's kind of the Silicon Valley view, which is like if you break it, then you can rebuild it. And boy, we could rebuild a lot better in so many dimensions when we think about state and local government, the flexibility, the seniority system, the unionization, the technology adoption. To what extent do you think this might actually lead to long-run benefits when you have to make do with less and maybe then you fix the system? Anybody but Dan or Tracy, it was more like...
I'm a Californian, so I'm sympathetic to the Silicon Valley view, and I am sort of genetically inclined toward optimism. But states are being asked to implement some of these like verification requirements very quickly, right? So I'm also I have a lot of respect for the authors of that op-ed, in particular for showing things like, well, this whole abundance criticism, right? Like the Inflation Reduction Act, infrastructure law, CHIPS, there were all these laws that were passed with the idea that there was going to be a big groundswell of support for them, which requires that you actually get the money out the door. And that didn't happen on the schedule that it maybe should have happened. And I feel like at another one of these conferences, we had a conversation about permitting reform and infrastructure. And there's often talk about that at the federal level, but I've always thought that doesn't make a lot of sense unless you're going to require states and localities to do it too, because you have layers upon layers upon layers of permits. And I think that's what happened with a lot of the clean energy stuff, but others in the room probably know much more about that. So I completely agree that state and local governments are, conservative, not known for moving quickly, and in part that's because of some structural issues that anytime you try to do modernization with investments in technology, there are concerns that it's a sweetheart deal. There's all the process stuff that they have to jump through to make sure that this is not just a giveaway to, some company. So I think there's stuff that sounds like, devolution and good government. But I think, look, they had to satisfy a target of savings reductions to conform with the instructions they were given with this act. And so these policies were designed to achieve those reductions. And the way that you achieve those reductions is by fewer people getting the services. So people who used to get Medicaid are not going to get Medicaid. People who used to get food stamps are not going to get food stamps. That might be because states are, getting people who were previously not supposed to be on the rolls off the rolls, but I think there's going to be a lot of people who were normally covered, and if there's a downturn, that could be very harmful, and then states will be in the position as the sort of provider of last resort of safety nets to figure out if they want to cough up their own resources to fill the gap.
Can I push?
To build on that quickly, the transformation inside a government agency of people and processes and technology is really hard. It requires a huge amount of management capability and leadership and vision. It can be done, but it is hard. And it's not as if the best and brightest minds in America are really eager to jump in and do the best possible job of kicking 10 million people off of their health insurance right now, right? Like we are not creating an environment where we are going to bring in the kinds of people that you need to bring in to do these transformations well, because they are going to be transforming something that is also in the process of fundamentally breaking. And so that makes me very worried about these storylines about institutional change, because I just don't see how you recruit the people who can actually do the institutional change.
Many of them are no longer working for the federal government.
Fair enough.
There's an outflow of talent.
Did you want to jump in, Dan, before we open? No? Okay, great. So let's open it up for questions. Mics are going to be coming around. I will take 2 or 3 at a time. If you have a question, the man at the back, tell us who you are, where you're from.
Hi, Randy Sim from here. The dire warnings about rural hospitals, do you have any views on whether those are likely to come true, or whether there'll be something found to rescue them?
Yes, I am really worried about rural hospitals, and this predates the recent legislative change. Fundamentally, we are at a moment in our understanding of healthcare delivery where, like, nobody should be getting a hip replacement in their small local community hospital anymore. Like, you should be getting these high value services that generate a lot of revenue from hospitals. You should be getting your hip replacement and your back surgery and most other sorts of scheduled surgery. You should be doing at a regional center of excellence where you have a surgeon who does that same surgery all day, every day. And people get better care that way, and they are opting. Patients are choosing to get the kinds of care that generate revenue for hospitals outside of their communities. And we have not figured out a system where we can create a footprint for healthcare delivery that delivers in rural communities the services that people want to get close to home. Cardiac and pulmonary rehab, emergency care, OB services, high quality primary care. And so this is a stress that has existed for a long time and has been fraying the rural healthcare infrastructure, because as we have eroded the revenue base for small hospitals, we have not figured out how to create this footprint that actually makes sense. And now we are going to take $1 trillion out of the healthcare system over the next 10 years. And so I think that is rapidly going to accelerate the changes that are already underway. And a lot of places that were barely holding it together under the current structure are going to face, a sudden reduction in funding that is going to put them over the edge. And it's going to put them over the edge before we can do the work of figuring out how to finance the footprint that actually works in these communities.
Any questions? Adele, up front.
To what extent do you think that the stressors in higher ed is going to translate into fiscal stress for university towns?
Yeah, so as I said, there's going to be budget cuts, there's going to be layoffs, so there's going to be, employment is going to go down. The question is, how big are those impacts going to be? I would, back to Kristen's comment, the stressors on rural hospitals are also on rural higher education institutions. And we're going to see the same stressors as to whether or not institutions are going to be shuttered the way rural hospitals have been shuttered in some communities. Because we heard eds and meds earlier. These are two of the biggest employers, and even in the major cities, places like Atlanta, where I was university president, it was the universities and the hospitals were the big employers. So it is going to stress municipal governments. It's going to stress county governments, and in the rural areas, it's a depopulating areas. The younger people are leaving and going into the more populated areas. You're not reversing this. We're only seeing an acceleration of trends that are already underway and been underway for years.
Yeah, I would just think that you will see some stress in these university towns. I mean, if you just take D.C., which was downgraded because of 40,000 people at the federal level who were laid off over the past year, I think that proportionally, that's what you'll see in some of these towns. So I expect you'll see stress and layoffs. Many of these higher ed institutions are foregoing capital programs where they're just no longer spending money like they once were. And that has been a response to the funding issues.
What are we seeing in the DMV housing market? Because everybody's expected it to go bust, and so far not.
It's flat, but it's fortunate to have Amazon and others that are filling the void.
Okay. No more questions? Well, thank you so much, panel, for a great discussion. Dan, are you closing us up? Thank you so much. That was interesting.
Okay, I'm just going to offer some very brief closing remarks. I want to start by thanking all of the sponsors. So the Hutchins Center, and the universities that sponsor this work. I want to thank the staff. I think Hao-Wen Chen and Stephanie do a fantastic job making this thing go, and our ability to do this really depends on them. I want to thank everybody who participated. I think the papers, the discussions this year were really fantastic. And I'd like to thank everybody here, not to sound too much like Mr. Rogers, but it's good that you're here. We're happy that you're here. It's been fun to do this with you. We send out questionnaires after the event, so you may get in your inbox an opportunity to give us some feedback. I encourage you to give us that feedback. We read those very closely, and thank you, and see you again next year. So, cheers.